Okay, good evening everyone. Welcome to Byju's Exam Prep IAS. This is Sham Kagur here. Now, before I start the discussion, if there is no issue with the sound, can you please give me a thumbs up? Let me know that I'm audible to you so that we can start with the discussion. Done. Thanks a lot. Let's start. So, last week, what we have discussed, we started with the concept of money and banking, correct? Right, that is Thursday we started with concept of money, then Friday we continued with that, we finished different concepts in the banking sector. Let me basically recap what we have discussed. We started with the concept of money. Money is what? Money is nothing but medium of exchange, it's a mode of payment. Then we have discussed four types of money. One is basically the concept of fiduciary money, commercial bank money, commodity money, and the fiat money. The money that we are using today, that is the currency notes and currency coins, it is called as a fiat money, right? Then we have discussed the structure of banking in India. What is the structure of banking? At the top of banking structure, we have a regulator, Reserve Bank of India, and below Reserve Bank of India we have all these the banking structures as such. Generally, the most important structure is below RBI we have commercial banks. What are commercial banks? I told you, if you remember it correctly, commercial banks are those which are involved in collection of deposits and issuing of loans, that is a lending activity. Now, commercial banks are divided into two parts, right? One is basically the concept of the scheduled commercial banks as well as non-scheduled commercial banks. Okay, scheduled as well as non-scheduled. In case of scheduled, the argument is very simple. These are registered. These are under the second schedule of RB Act of 1934. Under the second schedule of RB Act of 1934, right? And second, the non-scheduled, these are not registered under the Schedule 2 of RB Act of 1934. Then we have seen the regulator of the banking sector, that is Reserve Bank of India. RBI, we have established RBI with the passage of an act, RB Act of 1934, from from 1st of April 1935. From 1st of April 1935, we have this particular authority that has been established in India, Reserve Bank of India. 1949, it was nationalized. 1937, it has been shifted, that is, headquarters has been shifted to Mumbai from Calcutta. And Reserve Bank of India performs a lot of very important functions. What are the important functions? First one, Reserve Bank of India is involved in or is in charge of controlling inflation in India. Regarding that, we have discussed monetary policy framework agreement. Okay. Point number two, RBI is also involved in printing and distribution of currency notes in India. Regarding that, what we have discussed, Reserve Bank of India, I said, is basically the authority which has been given the power to print and distribute all the currency notes except 1 rupee note. 1 rupee note as well as the coins are minted by Government of India, then distributed by Reserve Bank of India. After that, we have discussed where are the places where the currency notes are printed. Okay, what is the role of RBI in acting as basically the banker to the Government of India? What is the concept of a yield? What is the concept of a coupon rate in a bond? What do you mean by bond? Right, the treasury bills, dated securities, operation twist, etc. Then we started discussing the monetary policy tools or credit control tools. Monetary policy tools or credit control tools. I said monetary policy tools or credit control tools refers to set of measures which are available for Reserve Bank of India to regulate money supply. To regulate money supply. Basically, regulation means either the money supply will be increased or decreased. Change in the money supply. Now, there are two types of tools. One is called as a quantitative set of tool. Second one is qualitative set of tool. One is quantitative, second one is qualitative. Quantitative, only the quantity of money. I repeat, only the quantity of money supplied will keep on changing. Whereas in case of qualitative, we will regulate money supply. In addition to that, we will also target specific sectors. We can target specific sectors under qualitative. Under quantitative, we have discussed cash reserve ratio, SLR statutory liquidity ratio. we have discussed repo rate, we have discussed reverse repo rate, standing deposit facility, right? We have discussed open market operations, etc. These are the set of tools that we have discussed under the quantitative set of tools. In case of qualitative set of tools, we discussed only one tool, that is the first one, rationing of a credit. Rationing of a credit, which is nothing but right distribution of the credit. How does RBI control how the credit means loans or advances, how the loans or advances are given? How does RBI control or regulate that? Right, that is done through a tool by the name of priority sector lending, in short PSL, priority sector lending, PSL. PSL basically stands for percentage, percentage of credit issued, percentage of credit issued should go to following sectors. For example, I said right now, for most of the banks in case of India, it is 40%. For most of the banks, it is 40%. Sir, is there any other bank where it is more than 40%? Of course, yes. Today we'll have a look at it. We have regional rural banks, RRBs. Regional rural banks, PSL is 75%. We have small finance banks, SFBs. PSL is 75%. Generally, for most of the banks, it is 40%. What does 40% mean? 40% basically means 40% of the credit given by the banks should go to following sectors. What kind of sectors? We have agriculture sector, we have export credit, we have a housing infrastructure, we have startups, we have weaker sections of the society, etc., etc. There are a lot of participants, or let's say stakeholders, which are covered under rationing of credit. Done. So this is what we've discussed so far. Let me pick it up from where we have left off. Variation of margin requirements and the other types of the type of loans. I'm sorry, the type of instruments under the credit control tools. Now let's start. Rationing of credit is over. Let me go to the next one. Regulation of consumer credit. Regulation of consumer credit. Now, what do you mean by regulation of consumer credit? Listen carefully. We are starting the discussion now. Right? Regulation of consumer credit means the Reserve Bank of India may ask the banks to change EMI and reduce the number of installments. What do you mean by this? Let me explain. Point number one, what is EMI? EMI simply stands for equated monthly installments. EMI stands for equated monthly installments. Now, what is this equated monthly installments? Let's start. Imagine you take a vehicle loan, or you'll take, let's say, a housing loan. So whenever you take this kind of a loan, you'll have to pay certain amount every month. Correct? All of you know this. Start participating now. We are starting the discussion. When you take a loan, let's say a housing loan, personal loan, or a vehicle loan, etc., you will have to pay a fixed amount of money every month to the bank. That is in simple terms called as equated monthly installment. Now, let me ask you a very simple question. Let me ask you a very simple question. Imagine this EMI component. Imagine this EMI component will be increased from, let's say, 30,000 rupees to 50,000 rupees. Right now, in the market, loans are available where EMI component is, let's say, 30,000. What if I say RBI will ask the banks not to give loans at 30K EMI, but they will have to give the loans at 50K, 50,000 rupees EMI. So you please tell me, if the EMI amount is increased like this, will more people take loans or will lesser people take loans? Very simple logic, by the way. If this is done, do you think more people will take or less people will take? Don't you think with this kind of a change, lesser borrowers will be there in the market? Less people can afford 50K every month. So borrower numbers will come down. So automatically what will happen for the demand of loans? Demand for the loans will also come down. If the demand for the loans will come down, can I say in particular sector in the economy, let's say two-wheeler segment, four-wheeler segment, or housing loans, etc., the demand for the loans will come down. That can help us in controlling inflation. Does it make sense to you? On the other hand, let's say right now it is a 50K. The loan that is available is for 50K. Now it will be reduced to 30K. Now it will be reduced to, let's say, 30K. Can I say exactly opposite will happen? That is, if the EMI component will be changed like this, more people will take loans now. Demand for the loans will increase. Credit supply will also increase. This can be done when we want to promote, let's say, a two-wheeler segment. This can be done when we want to promote a demand for housing loans. This can be done when we want to promote, let's say, four-wheeler loans. So according to the requirement, very simple, according to the requirement, RBI will ask the banks to change the EMI component so that the demand for the loans will either increase or decrease. This is called as a regulation of consumer credit. Let me go to the third tool. Third tool under instruments of credit control, specifically qualitative. Specifically qualitative. What is the third tool here? Variation of margin requirements. Variation of margin requirements. Now, what is this concept of a margin? Let me start with a very simple example. Imagine you want to purchase a house. Okay, you want to purchase a house, but the value of the house will be, let's say, 1 crore rupees. Okay, value of the house is, let's say, 1 crore. You will go to a bank, you will apply for a loan. The bank says, sir, if the value of 1 crore is value of the house is 1 crore, you will have to pay 30 lakh rupees, and the remaining 70 lakh we will give loan. All of you okay with this? From your pocket, you'll have to pay 30 lakh, and bank will give you a loan of 70 lakh rupees. Now, this 30 lakh rupees is basically called as a margin. This 30 lakh is called as a margin. What is a margin? What is the value of the asset minus value of the loan given by the bank? Very simple, CSAT. What is the value of the asset minus what is the value of the loan? That is called as a margin. That is the amount that you will have to pay from your pocket. Now, let's say hypothetically, the bank will, rather than asking you to pay 30 lakh rupees, will change this to, let's say, 20 lakh rupees. Rather than asking the customers to pay 30 lakh from their pocket, will make it 20 lakh rupees. Now, please tell me, don't you think as a result of this, now more people can afford the loans? Yes or no? I'll repeat it again. Some of you are saying no. Listen carefully, my dear. In the first example, from your pocket, you paid 30 lakh, bank gave 70 lakh rupees. Now I'm saying bank will give 80 lakh rupees. You will have to pay from your pocket only 20 lakh rupees. So when this margin is getting changed like this, don't you think more people can pay 20 lakh upfront and later they'll repay the loan? Upfront money is also very important. Rather than paying 30 lakh, now they will have to pay only 20 lakh. So automatically demand for such loans will start increasing. What if I say vice versa? Exactly opposite. What if I say vice versa? That is, rather than 30 lakhs, bank will ask you to pay 45 lakh rupees. Bank will ask you to pay 45 lakh rupees. Bank will ask you to pay 45 lakh, and the bank will give 55 lakh rupees loan. Now, can we say basically because more money you will have to pay from your pocket, right? Again, basically, many of you are asking, right, how is that possible, etc., etc. There is a concept called as a down payment. There is this idea called as a down payment. What is down payment? Whenever you purchase any asset with a loan, how much money you will pay from your pocket, not from the bank loan. How much money you will pay from your pocket? That is called as a down payment. So whenever the down payment amount will increase, people will feel burdened by it. They'll feel this is too much. I cannot pay this much amount of money. So they will postpone the demand. On the other side, if the down payment component will come down, people will take a loan for 20 years, 30 years, 25 years. For a longer duration, they will take a loan and they'll be able to make this particular lower down payment. So argument is very simple here. Whenever the margin requirements will change, automatically the demand for such loans will also change in the market. Now let me go to the next one. Direct action, moral suasion, and publicity. Direct action, moral suasion, and publicity. Now let me ask you a very simple question. Last week, Let me know how many of you have come across the article in the newspapers where RBI has imposed penalties on many banks in India. Very simple question. Last week itself, again, not very far, right? Far away, not 1 year ago, not 2.5 years ago. Last week, hardly 1 week, right? RBI has imposed penalties on many cooperative banks in India. RBI imposed penalties on Paytm Payment Bank. Paytm Payment Bank. Why? What do you think is the reason? Why does RBI impose penalties like this? Reason is very simple. RBI, whenever the banks are not following certain guidelines, I repeat, whenever the banks are not following certain guidelines, RBI will warn them. RBI will caution them. RBI will send them notices. RBI will write articles about it. RBI governors or RBI officials will give speeches and they will warn in meeting. They will warn, etc. First, they will warn the banks. They will say, you are not following these guidelines. Please follow them. That is for your benefit. That is called as moral suasion. All of you okay? That is a process wherein if the banks are not following the guidelines or any of the let's say measures imposed by RBI, then RBI will warn, RBI will caution them. That is called as moral suasion. But even after that, what if the banks don't follow them? The banks will keep on violating these guidelines. Then RBI will say, we warned you, we cautioned you, but you're not following the guidelines. Hence, I will impose penalties on you. That is called as direct action. First warn them, then penalize them, right? So moral suasion and direct action. And the last tool, publicity. Last tool available to you is publicity. That is, as a RBI, it is available to you is publicity. What is publicity? Promote an effective public opinion for the policy implementation. Promote a public opinion for policy implementation. What is the meaning of it? Let me show you certain pictures here. Pictures. Don't worry. UPSC is not going to ask you about these pictures, but please look at both of the pictures and tell me in the comment section, why do you think RBI is providing these advertisements in the newspapers? Why does RBI advertise these in the newspapers? You must have seen in the newspapers, you must have seen television ads regarding this. They'll simply have a punchline, RBI कहता है. Correct? RBI कहता है. Why do you think RBI does all of it? Can I say, to create awareness, to educate common man? Correct? To create awareness amongst all of us, to create awareness as well as educate the bank customers, so that we can hold the banks accountable if they're not following these guidelines. For example, let me give a very simple example. Have you seen a particular ad where currency notes are torn? Currency notes, a person will put the currency note in the pant or in a shirt, put it in washing machine, and once they remove the cloth, the complete currency note would be crumpled like this. And suddenly they will give a notice say, or a notification saying that, don't worry, even if the currency note is torn, if the currency note is crumpled like this, you don't have to worry. Go to the nearest bank. You can exchange that with the nearest bank. Go to nearest bank. Give this old currency note. You can get the new currency note. So again, argument is simple. Even if you have not seen that, don't say, sir, I did not see it. Will UPSC ask me about that? Absolutely no. What is the logic? Why do you think RBI is spending so much of a amount of money and creating ads, right? Giving advertisements in the newspaper so that you as a customer, I as a customer are aware of what is RBI policy and whether the banks in which we have accounts, are they following these policies or not? Whether the banks are providing these services to me or not, I will have to know. I'll give a very recent example, very recent example. Very recently, RBI has told the banks, if a bank customer will close the housing loan in the next 30 days, bank documents should be, that is housing documents, should be handed over to the customer. Yes or no? Have you come across this? I'll repeat it again. Very recently, RBI has brought in a new policy where RBI says, If a customer will close the loan account, housing loan account, then the bank has to return the housing documents to the owner. I mean, if you'll say, what is the logic? What is this housing document, right? What it has been done, why it has been done? Whenever you take a housing loan, I repeat, whenever you take a housing loan, you will keep house documents with the bank, original house documents. And it makes perfect sense. Otherwise, what you will do? You will take a loan from a bank, you will sell the house to somebody else. Right? So, possible or not, it's perfectly possible. People can cheat the banks. It has happened in the past. So, what bank says, I will give you a housing loan, you provide me the original documents of the house, right? The stamp duty paper, the housing plan, etc. Submit all those documents to me. Once you close the housing loan, I will hand it over. But it has been seen that many banks are taking longer period of time to hand over the housing documents to customers, right? They are taking a longer period of time. So RBI said, no, this will not work out now. Within 30 days, return the housing documents. Otherwise, I'll start penalizing you. You will have to pay penalty to the customer. This is a new law. This is not a law, but a measure which has been imposed by RBI on the banks in India. And this was there very much in the newspaper. In the coming days, you might even get advertisements regarding that. Logic is what? Why does RBI do that? So that you as a customer, I as a customer, all of us are aware of what is the policy of Reserve Bank of India. Done? So that is called as a publicity. That is called as publicity. Right? So these are the various tools which are used by Reserve Bank of India under the quantitative head as well as the qualitative head. Right? Collectively, this is called as the credit control measures or monetary policy tools. In the earlier class, many of the students were asking, how does RBI decide how much money to increase, how much money to decrease, when to increase, when to decrease, etc. Now, to understand, there is a concept called as supply aggregates or money aggregates, monetary aggregates. Let's try and understand all of them. Let's start now. Money supply or monetary aggregates. Under this, there are five measures, right? Slightly technical, please listen to me carefully. There are five aggregates. Aggregates means totals. These are M0, M1, M2, M3, and M4. Now, before I start the discussion, please tell me, do you remember the concept of liquidity? Let me know. Do you remember the concept of liquidity? We have discussed this last week, Thursday. Thursday, at the end of the session, this is what we have discussed. Liquidity is nothing but it's a feature. It's a feature of an asset. How quickly we can convert this into money. How quickly we can convert this into money. That is, asset can be converted into money. That is called as liquidity. Now, please tell me, between savings bank account and fixed deposit, between savings bank account and fixed deposit, which is more liquid? Between savings bank account and fixed deposit, which is more liquid? Savings bank account. So essentially, in a nutshell, can I generalize it and say, the demand deposits, I repeat, the demand deposits are more liquid compared to time deposits. And what is a demand deposit and time deposit? Friday session, Friday discussion, right? The demand deposits, can I say, are more liquid compared to time deposit. Please remember this particular point. We will start using it now. Point number two. Point number two, whenever you talk about monetary aggregates, we will start discussing M0 and then we will go down to M4. Generally, there is two classification. One classification, please have a look at it. M1 and M2. I'll write it here. M1 and M2 is referred to as narrow money. Why, you'll understand in some time. Just give me a minute. M1 and M2 is called as narrow money, and M3 and M4 is called as broad money. M3 and M4 is called as broad money. Why M1 and M2 narrow? Why M3 and M4 broad? You will understand when we start discussing. Let's start. Now, what is M0? M0 in a nutshell, many of the experts say M0 in a nutshell is nothing but M0 is a high powered money. M0 is called as high powered money. High powered money, or else it is also referred to as monetary base. M0 is also referred to as monetary base. How do we measure how much is the monetary base? How much is the high powered money in the whole economy? M0 is measured by taking into consideration currency in circulation plus banking deposits with RBI and other deposits with RBI. I'll repeat it again. What is M0? M0 is referred as a high powered money or a monetary base, wherein M0 is calculated by taking the sum total of currency in circulation plus banks deposit with RBI and other deposits with RBI. Let's go point by point. Can I say central government will keep deposits with RBI? State government will keep deposits with RBI. Anybody has a problem with this statement? I'll repeat it again. Central government and state government both have accounts with RBI. So they will keep deposits with RBI. I'll keep it under the concept of other deposits with RBI. What about the banks? Don't you think banks will also keep deposits with RBI? Anybody has a problem? Banks will also keep deposits with RBI. I'll keep this in the second component. What about the first component? Currency in circulation. Currency in circulation. Here is the Reserve Bank of India. Let's say Reserve Bank of India will print 100 rupee and supply it into the economy. Reserve Bank of India will print 100 rupee and supply means right, push this 100 rupee into the economy. Now this 100 rupee essentially is called as currency in circulation. Anybody has a problem? The money that has been printed and distributed by RBI. Printed and distributed. Again, please understand, printed obviously means currency notes. Distributed means currency notes as well as currency coins. I'll repeat it again. Please do let me know if anybody has a problem with this. Currency in circulation means the money that has been printed and distributed by RBI. What does RBI distribute? RBI distributes currency notes as well as currency coins. So can I say whatever currency notes and coins has been distributed by RBI, that has been supplied by RBI to the economy, is currency in circulation. Can I go forward here? Anybody has a problem? Anybody has a problem? In fact, I'll give you a technical idea now. Listen to me carefully. Slightly technical. Please listen to me carefully. M0, many of the experts say M0 is nothing but represents liability of RBI. I'll repeat the statement here. M0 represents liability of RBI, liabilities of RBI. What do you mean by liabilities? Liability means anything that RBI has to pay. That is called as M0. Now, many of you will have a doubt here, especially the first part, that is currency in circulation. Many of you will say, how is that liability? I'll come to that. But tell me, is everybody okay with the second and third? Why is it counted as a part of liability of RBI? Let me know. Second and third. First one I'll explain. Slightly technical, I'll explain it. But second and third, everybody is okay. The banks will keep deposits with RBI, which RBI has to return back. The government will keep deposits with RBI, RBI has to return back. So second and third is basically right the liability. But why? Why the first one, that is currency in circulation, why do I say it is a liability of RBI? Now let me start with an example here. Listen to me carefully. Please listen to me carefully. Imagine you are the bank, I am RBI. Okay? Listen carefully. You are the bank, I am Reserve Bank of India. Now, I've printed 100 rupee. I've printed 100 rupee. Can I simply give it to you? Let me know. I've printed 100 rupee. Does RBI simply give this 100 rupee to the bank? If they do that, that will increase money supply. It can cause a lot of inflation. There has to be an exchange. There has to be an exchange. Something has to be exchanged. Let's say hypothetically, I'll bring your friend back. Let's say hypothetically, don't worry about coupon rate, don't worry about everything else. So focus on the value here. Focus on the value. Only focus on the value. Okay. Now you have this particular bond. I will give you 100 rupee and you will give me this particular bond. Is it okay? RBI will give you 100 and you will give me this 100 rupee worth of bond. A simple question to you. You tell me, for me, RBI, for me, this bond, can I say it is an asset? Let me know. Can I say this particular bond for me, that is for RBI, it is an asset? So understand this logic here. There is a concept called as balance sheet. I'll introduce one more concept to you. Listen to me carefully. There's a concept called as balance sheet. What is this concept of a balance sheet? Balance sheet is maintained by every company. Balance sheet is maintained by every company, right? RBI is also one of the entities which is working in India. Whenever you talk about balance sheet, there are two sides to the balance sheet. One side is called as a liability and the other side is called as asset. Commerce students, BCom students will be very happy now, right? Even MBA, right? Finance students will be very happy. And just to make you very happy, I'm making it very technically sound. That is, right side is asset, left side is liability, right? It's basically a technical argument. Left side should always be a liability, right side should always be an asset. Now, on one side is a liability, on one side is the asset. And by the name itself, please look at the name, balance sheet, right? So balance sheet means what? We have to balance. All of you okay? Right? Science students, art students, don't worry. UPSC is not going to ask you how to prepare a balance sheet. That is not important. Listen, just understand the concept behind it. Balance sheet means you'll have to balance both the sides. Now, let's start. Let's assume only one transaction. I have printed 100 rupee. I've printed 100 rupee. I will give it to you. You will give me this particular bond. So can I write bond worth 100 rupee on the asset side, cash worth 100 rupee on the liability side? It has to balance. I hope you understand. You have to balance, right? Ultimately, it has to get 100, 100. Although there are a lot of transactions, I'll show you the actual balance sheet of RBI. Don't worry, I'll show you actual balance sheet of RBI. Then you can tell me whether there's a balance on both the sides or not. But you don't worry, stick to the basics. You don't have to become a commerce student for this. Idea is balance sheet. Balance sheet has asset side and liability side. And at the end of the day, both the sides value should be same. So if I get a bond worth 100 rupee, it simply means I've given a cash of 100 rupee to you. So can I say cash issued by RBI? Issued by RBI, that's very important, right? Think of it. I've printed 100 rupee. I'm RBI. I've printed 100 rupee. I'll keep it in my pocket. I will not give it to you. Do you think it is a liability? Let me know. Please participate. I'm RBI. I've printed 100 rupee. I'll keep it with myself. I'm not giving it to you. Does it become a liability? No, it is still with me only. It is an asset then. But in this case, I've given 100 rupee. I've collected a bond from you. So I will write bond worth 100 rupee on the asset side, cash that I've issued, right, 100 rupee on the liability side. So please do let me know. At least now, does it make sense? Why do we write currency in circulation whenever we say liabilities of RBI? Can I go forward now? Now, simple question to you. Simple question. What if currency in circulation increases? Don't you think automatically money supply in the economy will increase? Think of it and do let me know. Currency in circulation increases. Don't you think automatically it means money supply in the economy should also increase? If you ask me how is that possible, do you remember this particular cycle? Let me ask you. Do you remember this particular cycle? Fractional reserve system, where 100 rupee printed by RBI here, right, will be used to create loans, not to print money, to create loans in the economy. So that is the reason, please remember it. If the currency in circulation increases, we also expect money supply in the economy to also increase. That is the reason this is called as a monetary base or high powered money. That is the reason this is called as a monetary base or high powered money. Now let me go to M1. Let me go to M1. M1 and M2 are referred to as a narrow money. M3 and M4 are referred to as broad money. Why? You will understand it now. Now, here is, let's say, 100 rupee with me. Here is 100 rupee with me. Can I say I can keep 100 rupee in the form of a savings bank account in the bank, or I can keep it in the form of fixed deposit in the bank? Let me know. I can keep this money in the form of savings bank account or in the form of fixed deposit, or many of you will diplomatically tell me, sir, can I do both? Of course, yes. 40 rupees, you will keep it in the savings bank account. 60 rupees, you'll keep it in the fixed deposit. Both are okay. Don't worry about it. But argument is simple. This 100 rupee that will be kept in the bank will be further circulated in the economy in the form of either new loans issued, which will again come into the banking sector, either in the form of a fixed deposit or again in the form of savings bank account, which means this money will keep on getting circulated. Please remember this. Money will keep on getting circulated again and again in the banking sector. Now, what is this M1 and M2? Point number one, M1 is basically calculated this way: currency held by the public plus demand deposits in the banking sector plus other deposits with RBI. Now, why is this M1 and M2 called as a narrow money? Please tell me, please look at it and tell me. Can I say any money which is being circulated in the economy, listen carefully, any money that is getting circulated in the economy can be in the form of a cash, can be in the form of a demand deposit, can be in the form of time deposit. Correct? The money circulation, right? How much money is there? It can get circulated in the form of either cash or in the demand deposit or time deposit. But out of all of this, can I say cash as well as the demand deposits have very high liquidity? Correct? Out of cash, demand deposit and time deposit, I'm saying cash and demand deposits have very high liquidity. That is the reason whenever you are accounting, whenever counting only the cash, demand deposits, etc., which has very high liquidity in the economy, this is called as a narrow money. Anybody has a problem with this? Please do let me know. Right? Let's say hypothetical. I'll give a very simple example. You should give me the answer. Whatever is the monetary base, don't worry about monetary base. I'm saying currency held by the public. Currency held by the public is, let's say, 500 rupee. Demand deposits in the banking sector are, right, let's say 1000 rupee, and time deposits which are there in the banking sector are, let's say, worth 2000 rupee. Now, simple question to all of you. I want to find out if this is a total money supply in the economy. I want to find out which of this money has very high liquidity. Which amongst this has very high liquidity? Can I say 500 plus 1000 rupee? All of you okay with this? Because demand deposits you can withdraw at any point of time. You can withdraw at any point of time. So very high liquidity. So I will count both of them as a part of narrow money. Narrow money means that part of the money supply which has very high liquidity. All of you okay with this? All of you okay with M0? And how do you understand what is the importance of all of it? You will understand. Just give me 2 minutes. You will understand the importance. Let me go to M2 now. Let me go to M2. M2 is also narrow money. Why? You will take M1 as it is. You will take M1 as it is. To this, you will add post office savings deposits. Post office savings deposits. What is the meaning of post office savings deposit? How many of you know that in the post office you can open a savings account? Post office, not in a bank. Post office, not even postal bank. I'm saying post office, right? So earlier it was very famous, especially in rural part of India. Especially in rural part of India, it was very famous, right? Even today, in certain parts of India, people, because they do not have access to banking units, They go to post offices, and within post offices they have savings deposits. But please understand, the savings deposits in the post offices are not the same as savings bank account in a bank. Is the logic okay? I'll repeat it again. The post office savings deposits are less liquid compared to the accounts in a bank. That is the precise reason. That is the precise reason. What RBI does is RBI will count a post office savings deposit, right, along with narrow money, and they will call this as M2. And M2 is also narrow money itself. But please tell me based on this, can I say between M1 and M2, M1 will have more liquidity? Does it make sense to you? Between M1 and M2, M1 will have more liquidity. Come to M3. Now I'll tell you how to apply, how do you understand, etc. etc. Let's start. M3 is basically take M1. Take M1. That is cash held by the public, right? Plus demand deposits on the banking sector, other deposits with the bank. Now to this, add time deposits which are there in the banking sector. Add time deposits which are there in the banking sector. Okay, this is point number one. Now look at M1 and M3. Point number one, can I say M1 has more liquidity? Look at M1 and M3. Can I say M1 has more liquidity? No difficulty in that. M1 will have more liquidity. Point number two, sir, why do we need to calculate all of this? What is the importance of all of this? Why should we understand all of it? Imagine your RBI governor. Time is 5:40. Congratulations, I'm making you RBI governor. Okay. So let's say you're RBI governor. Please tell me, why do you think people will keep money in demand deposit? Think of it. Why do you think people will keep money in demand deposit even though they have an option of time deposit? Please think correctly. Please think correctly. Many of you miscalculate, right? Misunderstand all these concepts. Reason is very simple. If you have money and you know that you might require money after 1 month, after 1 week, after, right, 2 days, etc., because you don't know when emergency will come, when you will require money, you don't know. For that, can I say you will keep money in demand deposit? Correct. That is, in simple terms, if you have consumption requirements, if you have consumption requirements, you will prefer to keep money which has more liquidity, so that you can withdraw at any point of time. But on the other side, if you don't want to use this money for consumption, you want to save money, then basically you will opt for time and deposit. You will keep money for 15 months. You will keep money for, let's say, 444 days. You will keep money for 5 years. Why? Reason is you do not have use of this money in the immediate future. So you will simply say, because anyways I don't want to use it, let me earn more interest by keeping the money in a fixed deposit or a time deposit. Correct? Does it make sense to you? Now please tell me, you think of it. Please tell me, you are the RBI governor. If people will start keeping more and more money in the demand deposit and M1 keeps on increasing, M3 starts decreasing, and inflation rate is already high. I'll repeat the situation. Listen carefully. Inflation rate is very high. People are keeping more money in demand deposit, and as a result of this, M1 is increasing, M3 is decreasing. In that particular situation, will you reduce interest rates or will you increase interest rates? Think logically. Please think logically. Right? Don't you think you should consider increasing interest rates in this situation? Some of you are saying we will reduce it. My dear, listen carefully again. Inflation rate already high. Inflation rate already high. And let's say M3 is either stable or declining. On the other side, M1 is increasing. M1 is increasing. So in this particular situation, if you reduce interest rates, it means inflation is higher. People are keeping lot of money for consumption, which means the demand will also be higher. Are you not further fueling inflation by reducing interest rates? Are you not fueling inflation by reducing interest rates? Rather than that, don't you think you should make it difficult? Difficult means more costly for people to take loans. Yes or no? You should make it more costly for the people to take loans because already they have got lot of money. They want to spend it. Demand would already be very high in the market. So does it make sense? How does RBI use M1? How does RBI use M3? How do they interpret what is happening in the economy, etc.? That this is how you need to understand. Is it okay? This is how you need to understand all these concepts. Please do not by heart. Many of you end up by hearting it. Because in the books they have given M0, M1, M2, M3, M4. What is their formula? What is their meaning? You'll simply by heart it. But rather than that, go behind the concept, you will understand it. Okay, done? I thought it was SBA interest rates. Okay, done. Now go to M4. Go to M4. M4 is M3 plus post office savings deposit. Right? Much more comprehensive measure of money supply in the economy. Now let me use M1 and M3. Let me use M1 and M3 and M0. There is one more concept called as money multiplier. There is one more concept called as money multiplier. Money multiplier. What do you mean by money multiplier? Money multiplier basically refers to what could be, or what would be the maximum amount of money supply increased by change in the monetary base. I'll repeat the statement. I'll repeat the statement. What could be, or what would be the the increase in the monetary base with change in, what would be the increase in the money supply with the change in the monetary base? Right? For example, if M0 increases, can I say money supply should increase? Correct or not? Money supply should also increase. Correct? It should increase. That makes perfect sense. Because if I get 100 rupees, I'll not keep it with myself. Right? I will deposit in the bank. Because of the fractional reserve system, money supply in the economy will increase. So if M0 monetary base increase, money supply increases. But now the question is, if I increase M0 by, let's say, 100 rupees, let's say, if I increase M0 by 100 rupees, I want to find out overall money supply in the economy will increase by how much? I hope you understand my statement. I'll repeat it again. If I increase monetary base by 100 rupees, overall money supply will change by how much? Some of you are saying it will change by 100 rupees. No, please tell me, does it make sense? If you increase M0 by 100 rupee, money supply will change by 100 rupee. How? How? Where is the concept of fractional reserve system then? Where is the concept of fractional reserve system? Right? So don't you think if you increase money supply by 100 rupee, right? If you increase monetary base by 100 rupee, money supply should change by a larger number. That is the concept of money multiplier. How do we calculate it? Look at the number and please do let me know, does it make sense or not? M3 upon M0. Don't try to calculate. This is the formula. Understand this. Don't try to calculate. This is the formula. M3 upon M0. What is there in M3? I'll make it simple to you. How do you understand it? What is there in M3? Can I say time deposits are there in M3? Correct? Time deposits are there in M3. What else is there? Demand deposit is there in M3. What else is there? Currency held by the public is there in M3. Don't you think these are the three very important components of overall money supply in the economy? Yes or no? Don't you think these are the three very important components? Other components are there, but these are the three very important components which are there in the money supply. If you keep on using cash, you pay, somebody will use that money to pay to somebody else. If you keep this money in the bank deposit, bank will issue loans, Again, that loan will come again in the banking sector, again will be used as a loan because of fractional reserve system. So argument is simple here. M3 is a broader money supply. Broader means it covers more type of money supply in the economy. At least now all of you will understand why this is called as a broad money. M3 will cover more types of money supply. It will not only cover M1, it will also cover right the time deposits. Hence broader measure of money supply. Right, M3 upon M0. Now let's say hypothetically, M3 is 1,000 rupee and M0 is 100 rupee, which means if RBI will increase money supply by 100 rupees, if RBI will increase money supply by 100 rupees, can I say overall money supply will change by 10 times? Correct? If RBI will increase money supply by 100 rupees, overall money supply will change by 10 times. Does it make sense to you? Can we go forward? I'll just give you one more conceptual understanding here. Please think of it. To increase money supply or to decrease money supply, do you think RBI has to always print and supply money? Can RBI change CRR to do the same thing? Let me know. Can RBI use CRR, cash reserve ratio, to do also the same thing? Can RBI use SLR to do the same thing? I hope you understand this. Even RBI can use CRR, SLR, etc. to regulate money supply in the economy. We have discussed this yesterday, Friday only. Many of you are asking how. It doesn't make sense. My dear, if RBI will increase the CRR, don't you think bank will have to keep more deposits with RBI? Automatically, how much money is there with bank to give loan will come down? Yes or no? Let me write no. Give me an answer. If RBI will increase the CRR, bank will keep more money with RBI. Bank will be left with lower amount of money to give loans. As a result of this, overall money supply will it not come down? What is the meaning of CRR? CRR means cash reserve ratio. CRR means cash reserve ratio. Okay, done. Right, let me prove it. Do you see these reserves? Let me change the color. Do you see these reserves? Instead of 10%, what if RBI will make this 25% or let's say 20%? Instead of 10%, what if the reserve is changed to 20%? Don't you think at every step, how much a loan is created, the value will start coming down? Think of it. At every step, how much loan is created, value will come down, which means how much deposits again will come to the banking sector will also come down. I'll take a very simple example, by the way. Those are asking, how is that possible? Imagine reserves is 20%. Out of 100 rupee, the bank will keep 20 rupees with itself and will give a loan of, let's say, 80 rupees to company X. Company X will purchase material from company B and pay 80 rupees to company B. Now, company B will deposit not 90, instead of that, it will deposit 80 rupees in the bank, which means overall money supply in the economy will come down. So, again, logic is very simple here. Can RBI use a CRR also to regulate M1, M3, etc.? SLR to regulate M1, M3? Of course, yes, they can do that. RBI has generally done it in the system. So this is how RBI will decide how much they will increase money supply, whether should they increase money supply when M1 is very, very high, right? And inflation rate is also very, very high. So they will decide based on all of it. Done? Okay, so again, this is slightly technical. You will have to revise it. Please revise it, right? Don't worry, revise it. Once you revise it, automatically it becomes much more clear. Okay, let me show you what is the balance sheet of RBI. Please do not by heart anything. It's very, very technical. This is very, very technical. Do not by heart balance sheet of RBI. It is not at all required for UPSC. Now, just make observations. the notes issued by RBI, the notes issued by RBI, is it a part of the liability or part of the asset? Right? The instruments, right? The instruments such as loans given by RBI to banks, loans given by RBI to government, the bonds which are purchased by RBI, either of government of India, state government, or a foreign government, is it part of the asset or a liability? Part of the asset. So again, please do not by heart anything here. Please do not by heart anything. Logic is simple, right? These G securities, right? The loans given, etc., all of them will be part of the asset. The currency notes issued will be part of the liabilities of the balance sheet of RBI. Okay. Now, let me go forward. Let me go forward with other functions of RBI. Next function, RBI is referred to. RBI is referred to as banker to the bank. RBI is also regulator of the banking sector. And there is one more name for RBI. Please remember this. This was asked a couple of years ago by UPSC. RBI is also referred to as Bank of Last Resort. RBI is also referred to as Bank of Last Resort. I'll tell you why. Bank of Last Resort. Now, why this is called as a banker to bank? Whether it is a normal times or there is an emergency, etc., doesn't matter. Banks can always approach RBI and borrow from RBI. Is it okay? Banks can always approach RBI and borrow from RBI. Hence, it is referred as a banker to banks. Now, why it is referred to as a bank of last resort? Bank of last resort. Why? Whenever banks are facing crisis, please remember this. Whenever the banks are facing crisis, banks, by the way, whenever the banks are facing crisis, such as a bank is running out of cash, a bank has a lot of deposits which are being withdrawn, it urgently requires money, etc. Whenever the bank is facing a crisis, the banks can always approach RBI. The banks can approach RBI and borrow from Reserve Bank of India. That is the precise reason RBI is also referred as a bank of last resort. That is, last resort means what? They have tried to borrow from different sources, they are unable to do that, or it is not sufficient, then only person or only institution that is the option for them, the savior for them, it is Reserve Bank of India. So RBI is also referred as a bank of last resort, right? It will be the lender whenever there's a crisis in a particular bank. And third, regulator of the banking sector. Regulator means what? Regarding the regulation, right? Regulation means supervision. Supervision of the banking sector. It will come under the Reserve Bank of India. For example, you want to open a bank. You will have to take a license from RBI. You cannot simply do that. You'll have to take a license from RBI. You want to acquire one more bank, then RBI has to approve it. You want to close the bank, RBI has to approve it. You want to open branches, RBI has to approve it. You want to do certain kind of activities, right? RBI has to approve it. So RBI is referred to as a regulator of the banking sector because the supervision of the banking sector, the powers of it will be with Reserve Bank of India. Okay, done. Next, RBI is also referred to as a manager of forex reserves. Manager of forex reserves. Now, what do you mean by forex reserves? Please remember this. Forex reserves are a sum total of four components. Forex reserves are a sum of four components. What are the four components? One is gold. Second one is STR. Please read what is given in the bracket of STR. Don't keep on asking questions on STR. Okay, will be covered under IMF. Foreign currency assets. What do you mean by foreign currency asset? RBI will hold bonds of government of UK. RBI will purchase bonds of government of USA. RBI will keep dollars. RBI will keep rupees. RBI will keep pound, euro, etc. Right? Foreign currency assets. FCA, foreign currency asset. In fact, all the four. Between all the four, The highest component is always FCA, foreign currency assets. And finally, reserve tranche, that is the fourth component, will also be covered under IMF. Will also be covered under IMF. Done? Right? So this sum total of all of this is called as a forex. Who is the manager? Manager means who will keep all these forex reserves in India? It is done by Reserve Bank of India. And later we'll discuss regarding this. Please don't worry. Later we'll discuss what is the use of forex reserves. If you're reading newspapers, you will know this. But anyways, when I take up international trade, I will tell you how does RBI use these forex reserves to stabilize, to basically stabilize rupee versus a dollar exchange rate. How important are these forex reserves, etc. We'll understand this later. Please don't worry, because to understand this, you need to understand, right, what will happen if you run out of forex reserves. That is not the situation. If you have been following the current affairs, you'll know what has happened in Sri Lanka. You'll know what is happening in Pakistan. Why? One of the reasons is they do not have forex reserves. They basically don't have any forex reserves. They have run out of forex reserves. That is the reason there's a crisis in both of our neighbors. Done? So please don't worry. Please don't worry. We'll understand it later in detail. What is the importance? Done? Can we go forward here? Now, in the context of bank of last resort, I just want to discuss one more tool here. What is the tool name? Marginal standing facility. There is one more tool, marginal standing facility. Marginal standing facility, MSF. Marginal standing facility. Now, what is this concept of marginal standing facility? Follow this very carefully. Imagine here is a bank. Okay. This bank right now is experiencing lot of cash withdrawals. Can it happen? Think of it. Can this happen? The bank is experiencing lot of cash withdrawals. Of course, yes, it can happen. Multiple reasons. For example, what if it is a festival season? Let me know. What if it is a festival season? Can there be a huge amount of cash withdrawals during festival season? Of course, it can happen. What if customers are losing faith on this particular bank? They're worried about their deposits. That could also be the reason why they are withdrawing. So there could be multiple reasons why continuously cash withdrawals will start happening with the bank. But whatever it is, don't worry. What is the situation? Can I say this bank requires money immediately? This bank requires a lot of cash. It requires money. Generally, in such situations, again, not only in crisis, during normal times also, if they are not able to meet SLR norms, think of it. What if a bank is not able to meet SLR conditions today? So there are multiple reasons why the bank would require money only for short duration, only for short duration. In this situation, there are two options. This bank can borrow, I repeat, this bank, I'll call this as bank one, can borrow from another bank. Everybody is okay with this? Bank one can borrow from another bank. That is there, it is allowed. Perfectly correct, nothing wrong with that. Right? Because bank two might have lot of deposits. It has lot of cash. Right? They want to give loan to somebody else. They will give the loan to bank one. Right? So that is one possibility. But what if this is not feasible right now? What if bank 2 doesn't have sufficient money? Bank 2 also says, I also don't have money. My customers are also withdrawing money. In that case, that is in simple terms, please remember this is called as interbank lending. This is referred to as interbank lending. What if interbank lending is not feasible right now? But the bank requires money. In such situation, this bank one can approach Reserve Bank of India. It can approach Reserve Bank of India and is allowed to borrow under a tool called as marginal standing facility, MSF. There is a tool called as marginal standing facility. Now please tell me, there is a term standing in the name. There is a term standing. What is the meaning of the term standing there? What does it indicate? Let me see how many of you remember, how many of you are following what we are discussing in the classroom. Can I say standing? If it is there in the name of a tool, it simply means it is available at any point of time for a bank. Correct? It is available throughout the year, unlike repo, unlike reverse repo, etc. So argument is there is a tool available for the bank which is called as a marginal standing facility, where bank one can borrow from RBI for very, very short duration. Very, very short duration, generally for overnight purposes. That tool is called as a marginal standing facility. Now, next point, you tell me, if a bank is there in the crisis, or if there is an emergency for the bank, they require the money urgently, they will approach RBI. Don't you think RBI will penalize the bank for mismanagement of the funds? Correct or not? RBI will simply say, you're mismanaging funds then. You should have planned better. Right, you are not following all the guidelines. There is something wrong with how you are practicing your business, etc. So what does RBI do? RBI will basically say, I will give you a loan. I will give you a loan for, right, short duration, generally overnight basis, but I will charge you higher rate of interest. Please remember this. I will charge you higher rate of interest. Right, the rate of interest charged by Reserve Bank of India on marginal standing facility will be greater than repo rate. Will be greater than repo rate. Let me prove it to you. Observe this particular picture. Don't by heart the picture. Observe it. Please tell me, is MSF rate greater than repo rate? Observe it and do let me know. Is MSF rate greater than repo rate? Right? So MSF is greater than the repo rate. Repo rate is greater than the reverse repo as well as STF rate. Okay? Right? This is a sequence of rates. So please remember it. Please remember. Okay, so this is basically the different functions of Reserve Bank of India. Now, let me go forward. Right, there is one more very important function in the current affairs. This is mentioned multiple times. DICGC. DICGC. What is this DICGC? Deposit Insurance and Credit Guarantee Corporation. The expansion of DICGC is in the first line. Please observe it. Deposit Insurance and Credit Guarantee Corporation. Now, the DICGC is an authority. It is an institution which Government of India has established, but it is kept under the ownership of Reserve Bank of India. I'll repeat. DICGC is an authority. It's an institution which has been opened, which has been started by Government of India, but it is under the ownership of Reserve Bank of India. Right? It is under the ownership of Reserve Bank of India. It is a subsidiary of Reserve Bank of India. Point number one. Point number two. DICGC is working as per the provisions of DICGC Act of 1961. A is nothing but Act. Deposit Insurance and Credit Guarantee Corporation Act of 1961. Point number three. What is the importance of DICGC? Imagine you will keep a deposit with the bank. The bank incurs a loss. And the bank says, sorry, I don't have money to repay your deposit. Is this a possibility? Can this happen? Right? Of course, it can happen. Can this happen? Of course, yes. In that case, who will guarantee your deposits? Who will provide guarantee to your deposit? It is this authority. DICGC, Deposit Insurance and Credit Guarantee Corporation. Whenever anybody will receive a banking license, whenever anybody, it could be an institution, it could be, right, an NBFC, it could be anybody who will receive a banking license in India from RBI, automatically, I repeat, automatically they will come under the coverage of DICGC, which means they will be covered under deposit insurance. How does the deposit insurance work? The Deposit Insurance Authority, whenever the bank will collect deposits, this authority will collect a premium. I repeat, will impose charges in the form of a premium, collect a premium from the bank. For every 100 rupee coverage, I repeat, for every 100 rupee coverage under the insurance, the bank will have to pay 12 paise to this particular authority. Which means, imagine this, here is a bank. If you keep 100 rupees with the bank will pay 12 paise and get this 100 rupee insured from this particular authority, DICGC, right? They will provide the insurance. Now, if the bank incurs a loss, the bank, let's say, will fail, then within 90 days, the DICGC will provide you the insurance amount. The DICGC will provide you insurance amount. But how much money can be insured under this facility? How much could be insured? The maximum amount that can be insured under DICGC is 5 lakh rupees. Up to 5 lakh rupees of deposits can be insured with the DICGC authority. Earlier it was 1 lakh rupee. Now it has been made by Government of India worth 5 lakh rupees. It is worth 5 lakh rupees in case of India. Please remember the number can be asked by UPSC. Can be asked by UPSC. I'll tell you why. All of you have read about or heard of, at least heard of, Silicon Valley Bank crisis in USA. Let me know. Silicon Valley Bank, SVB crisis in USA. Lot of these depositors lost money. Even in case of India, have you heard of Punjab Maharashtra Cooperative Bank, PMC? Punjab Maharashtra Cooperative Bank. Lot of depositors lost money in the PMC Bank as well. So after the PMC Bank crisis, Government of India stated that 1 lakh rupee deposit insurance is not sufficient. We will increase it to 5 lakh rupees. Right? So up to 5 lakh rupees of your deposits are insured with the DICGC. Done? And what kind of banks are covered under this? Commercial banks. Commercial banks are covered. For example, right, deposits with the commercial as well as cooperative banks, such as public sector banks, private sector banks, payment bank, small finance bank, cooperative banks, etc. The deposits in these banks will be covered under DICGC. But please remember this also, primary cooperative societies, any deposit that you keep with primary cooperative societies are not covered under this. The reason for that is very simple. Primary cooperative societies are not banks. Look at the name, you'll understand. Primary cooperative societies are societies, right? These are societies. These are not banks. Hence, these deposits are not covered under the DICGC. Right, so these are certain very important points regarding the concept of DICGC. Please be very careful. Questions can be asked, though it is there in the current affairs. So far, UPSC has not touched it. They have not touched DICGC, but they can ask you a question on it. Done? Right, so these are all the concepts associated with RBI. All these are associated with Reserve Bank of India. We have spent around 5 hours, 4 hours to 5 hours to only understand Reserve Bank of India. So please be very careful. That is very, very important. Hence, we have given a lot of weightage, a lot of scope to Reserve Bank of India. Having said so, is it the end? Should you stop reading about RBI altogether? Absolutely no. Don't do that mistake. Every now and then, RBI is there in the newspaper. They will introduce a tool, right? They will do this, they will do that, they will introduce a new policy, etc., etc. So all of that is important. Whenever you come across that, please read, update your current affairs. Again, I'm saying RBI is very important. Do not miss it. Read it correctly. Be very, very strong with your basics. Update your current affairs with RBI. Okay, now, next concept I want to discuss with you people is nationalization of the banking sector. Nationalization in the banking sector. Okay, now what is this concept of nationalization? Let's go point by point. Nationalization means transfer of ownership. Transfer of ownership. Right, from whom? From the private sector to the government. Whenever the ownership is transferred from the private sector to the government, this is called as nationalization. Right, we have come across this. This is not the first time I'm using the term nationalization. Earlier, while discussing concept of capitalism, socialism also, we have discussed nationalization. Point number one. Point number two, Government of India. Government of India earlier, not now, earlier has nationalized various private sector banks in India. To be very precise, there are two rounds of nationalization. The first round of nationalization was done in 1970, wherein 14 banks were nationalized. And second round, we nationalized 6 banks. So totally in case of India, in 2 rounds of nationalization, we have nationalized 20 banks. So what happened after 1980? Please understand. In 1991, there was a committee, Narsimham Committee. We'll discuss about Narsimham Committee after some time. Please don't worry. There was a committee, Narsimham Committee. Narsimham Committee recommended that we should not go for nationalization. Rather, we should allow private sector banks to operate in India. And the reason is very simple. Whenever you go for nationalization, it simply means private sector which are much more competitive, you are reducing competition in the market. So argument of this committee was don't go for nationalization. And now, please look at the situation now. Now government of India says we will not go for nationalization. There is no point. We will not go for nationalization, but rather we might go for privatization in the banking sector. We might go for privatization in the banking sector. For example, have you come across in the newspaper where finance minister says we will have 4 public sector banks operating in India? Let me know. If you have not heard of it, type it in Google, you will get it. Finance Minister says we will have 4 public sector banks operating in India, which means today there are around 10 plus public sector banks. Around 10 plus public sector banks. We will reduce the number to 4 public sector banks, which also means private sector will thrive, right? With public sector contracting, private sector participation automatically expected to increase. Competition is expected to be much better. But anyways, what is the logic? Why did we go for nationalization? First round in 1970, second round in 1980. Reasons are very simple. Point number one, if private sector banks are operating, the argument of government of India was they will only focus on profit. They will not focus on social welfare, they will focus on profit. And in order to earn profit, they will open more branches in cities. Correct? They will open more branches in cities. Who will open branches in villages? Who will open branches in smaller cities where customers will have to be provided with all these banking services? So government said, no, we will go for nationalization. We'll go for nationalization. Second, private sector banks, in order to earn profit, don't you think they will provide more and more loans to industries rather than providing loans to farmers, rather than providing loans to small businesses, etc., right, or artisans for that matter. So government was concerned that more loans will go to industries rather than going to, let's say, farmers, rather than going to, right, other smaller participants in the economy, weaker sections of the society, etc. So that was also the reason why government of India decided, let me go for nationalization, because once we go for nationalization, these banks will be under my ownership, right? For example, please tell me, between any public sector bank and private sector bank such as ICICI, don't you think ICICI is more focused on earning profits? Does it make sense to you or not? ICICI, right, is more focused on earning profit, whereas a public sector bank such as SBI or Bank of Baroda, of course, they also want to earn profit, right? Do not twist my statement. I'm not saying public sector banks don't want to earn profit. They also want to earn profit. But along with the profit, don't you think social welfare is also part and parcel of public sector bank operations? Can I prove it? Can I prove it? Right? Let me prove it to you. Where do you think maximum number of Pradhan Mantri Jan Dhan Yojana accounts have been opened? Private sector bank or a public sector bank? Right? So think of it. Again, this is not very difficult. You don't have to remember data for that. Right? Where do you think, a public or private sector, majority of Pradhan Mantri Jan Dhan Yojana accounts have been opened? It is with public sector banks. Right? Private sector is not worried about Pradhan Mantri Jan Dhan Yojana. They will meet the targets which have been given to them. But public sector banks, social welfare is a very important part and parcel of their functioning. Hence, right, these are some of the reasons why government of India went ahead with the idea of a nationalization. Now, some of you are saying, sir, I checked it in Google, etc., etc. The first round of nationalization did not happen in 1970. The Google, etc., somebody else will say it is 1969. Are they correct? Yes, they are also correct. I am also correct. How? Let me prove it. In 1969, Government of India went for nationalization, went ahead with nationalization. The decision of Government of India was challenged in the court, and the court struck down the idea for nationalization in the banking sector. Right, and that is the reason again in 1970 government introduced the concept of nationalization. So I hope you understand. 1969 we introduced but challenged, 1970 again reintroduced, that was actually implemented. Okay, so first round, second round, right? Today, right, exactly opposite. Government doesn't want to go for nationalization. It is actually consolidating the banking sector by merging many of these particular public sector banks. For example, earlier there was a State Bank of Patiala, correct? State Bank of Patiala. There was a State Bank of Travancore. There was a State Bank of Bikaner. There was a State Bank of Mysore, etc. Today, do you think these state banks are present? All of these, right? There are five associate banks. All of these five associate banks have been merged into only one bank now, that is State Bank of India. Right? I'll give you one more example. Earlier, there was a bank by the name of Dena Bank. There was right, another bank, Vijaya Bank. These two banks now have been merged into Bank of Baroda, which means right now what is Government of India doing? Rather than opening more public sector banks or going for nationalization, Government of India has shifted to a new concept of a bank merger. They've introduced a new concept of a bank merger or large banks. I repeat, they've shifted to a new concept of a large bank or a bank merger. Right? Why does government do this? What is the logic behind it? Is there any importance to this particular policy of Government of India? Let's do the critical evaluation, pros as well as cons. What are the advantages and what are the concerns associated with that? First, let me start with advantages. Why is Government of India going for mergers? Right? Why they are creating these particular larger banks? Reason is, point number one, when you create a larger bank, don't you think they can become more competitive not only in India but also in the international market? Let me know. If people will keep, right, if people, I'm sorry, if the banks will become large, if the banks will become large, don't you think they will not only become competitive in India, but they'll become more competitive in the international market as well? Of course, yes. They can become competitive there also. So one is that we want to create big banks so that they will not only compete with Indian banks, they will also become competitive with foreign banks. Second one, instead of having three smaller banks, if I merge these banks and create a large bank, can this new bank give large value loan? Think of it. Can this new bank, can they give large value loans? Large value loans means, please remember, we will require loans for infrastructure. Correct? We will require loans for infrastructure. And one of the features of infrastructure loans is the loan value is very large. The loan value is very large. And remember the second point as well associated with the infrastructure. The loans which are issued is generally for longer duration. Loans issued is for longer duration. For example, you want to construct, let's say, a national highway of 500 kilometers. You want to construct a tunnel. You want to construct a bridge. Don't you think you will take a loan of 500 crore rupees or 2000 crore rupees or let's say 5000 crore rupees rather than taking loan of 50 lakh rupees or 20 lakh rupees? So value of the loan is very large. Value of the loan is very large. Second one is, you want to construct, let's say, 500 kilometer stretch of national highway or let's say a tunnel or a bridge. You will take multiple years to do that. You will not be doing it within 1 month or 2 months. You will take multiple years, and you will take more years to generate revenues. So automatically what will happen? You will not take a shorter period loan. You will take a very longer period loan, larger loan for a longer duration. So tell me, is a small bank suited to provide such loans, or a larger bank suited to provide larger loans? I don't think the second one makes more sense to you. Larger banks will be able to provide larger loans for infrastructure. And one more point I'll tell you, even today this is a problem. Listen to me very carefully. One more point I'll tell you. There's a concept of asset liability mismatch in the banking sector. Even today, that's a problem, by the way. There's a concept of asset liability mismatch. ALM, asset liability mismatch. Now, what is this asset liability mismatch? Let me explain this. Okay, imagine here's a bank. A customer will come to the bank, deposit 100 rupee. Right? Let's say it is a demand deposit. Deposit 100 rupee. The bank will give this loan, assume no reserves, assume no reserves. Bank will use this and give a loan to a company for, let's say, 10 years. For 10 years. And this is a deposit which was kept for only 1 year. Now, please tell me, is there a mismatch between the duration for which the deposit has been collected and the duration for which loan has been provided? Yes or no? Please have a look at it. Can I say there is a difference, a mismatch between for what duration the liability is there with the bank and what duration the asset has been given by the bank? This is called as asset liability mismatch. This is referred to as asset liability mismatch. And what is the problem with this? The problem is very simple. If the customer will come after 1 year, can there be? Again, I'm not saying it is going to happen, definitely 100%. Can there be a situation where bank might feel they don't have sufficient cash to allow the deposit withdrawal of 100 rupees? I'll repeat the statement. After 1 year, when the customer will come back to the bank to withdraw this 100 rupee, can there be a situation where bank will face issue because they might not have this 100 rupee? So the liquidity issue will be faced by the bank, correct? Liquidity issue will be faced by the bank. Second one, some of will say, but sir, bank can collect this 100 rupee from another customer. Absolutely correct. I'll tell you the problem with that. Imagine you have kept this 100 rupee with the bank. I'm the bank. When you kept this 100 rupee, the rate of interest was 4%. Let's say hypothetically. When you deposited this 100 rupee, the rate of interest was 4%. Now, after 1 year you have come, I want you to withdraw the 100 rupees. So I will collect 100 rupee deposit from another customer, but offer the second customer 5% rate of interest. Don't you think this higher interest rate will impose a higher burden for the bank? Yes or no? I'll repeat it again. Those who are getting confused, listen carefully. Listen carefully. You kept the 100 rupee today. I will give you 4% interest rate. After 1 year, you want to withdraw this 100. I don't have that. I will get this from one more customer. But after 1 year, what if rate of interest is 5%? Right? What the rate of interest is 5%. Don't you think the interest burden on the banking sector will increase? Of course, yes. So liquidity becomes a problem for the bank. Interest can also become a problem for the bank. All these are the problems associated with asset liability mismatch. Asset liability mismatch. And this is very famous in case of India's banking sector. Please remember. Very, very famous. Right? Banking sector in case of India faces this problem. If you ask me, sir, how can we address this particular problem then? Can I say, if there is somebody else apart from the banks, if there is somebody else in the market, if they can provide infrastructure loans, automatically the burden on the banking sector to provide such long tenure loans will come down. I'll repeat the statement again. Listen carefully. I'm saying, what if there is somebody else in the market in Indian economy who will provide infrastructure loans? Large value loans for a longer duration. If they are there in the market, don't you think automatically the pressure on the banking sector to give such loans will come down? And can that be a solution? Can that be a solution to address this issue of ALM in the banking sector? Then does it make sense to you? Does it make sense to you? Right. So think of it, because there is one concept. We'll discuss that. We'll discuss that. There is a concept for this. Government of India has set up a new authority by the name of NABFID, National Bank for Infrastructure, National Bank for Financing Infrastructure Development, NABFID, that we will discuss later. Please don't worry. Now, what are the advantages? Why is Government of India merging these particular banks? Let me have a discussion regarding this. Let's start. One, they will be able to compete with the foreign banks, right? Larger banks can provide loans for infrastructure. If larger banks are there, right, don't you think the technological resources will be pooled means collected together? Human resources can be collected together. Rather than having multiple branches only one place, they can close some of the branches, open branches somewhere else. All these are some of the advantages associated with the concept of a larger banks. But having said so, can there be a concern? Can there be a concern or issue related to concept of a larger bank? Of course, yes. If there are advantages, there has to be certain concerns, there have to be certain disadvantages. One, what if I say, again, hypothetically, don't panic. What if I say State Bank of India has incurred a huge amount of loss, they are going to shut down? Can you imagine the kind of impact that will create on whole Indian economy? Just think of it. Again, hypothetically, imagine. I'm not saying it is falling. I'm not trying to create any panic here. I'm simply saying, imagine the largest bank in India incurs losses and it will shut down. So imagine the impact that it will create on the whole Indian economy, agriculture sector, right, industrial sector, customers who have kept deposits, right, NBFCs who will take loans from, right, SBI, etc. So the impact will be very, very huge. So now tell me, there were, let's say, three banks. Earlier, let's say there were three banks, or let's say four banks. One of the bank will fail. Example one. Okay, one bank will fail. Now, what you have done, you have merged all the four banks to create only one bank. This new bank, which is a very large bank, will fail. So, don't you think by creating larger banks, if this larger bank will fail, the impact on the economy will be much, much higher? Of course, yes. Of course, yes. The impact will be very, very huge. So, there is always a concern. Second one, what about employees? What about employees? If four banks are merged, if B will be merged with A, C with A, D with A, do you think they will require the same number of employees now? No, they will not require the same number of employees. They will ask some of the employees to take voluntary retirement. If they don't take voluntary retirement, they'll be removed from the service. They'll be removed from the job. So don't you think job security is a concern here? Some of the people will be losing jobs because of these kind of mergers in the banking sector. Third one, what about work culture? What about work culture in some of the institutions? I'll give a very simple example. In some companies, there'll be 5 working days. In some companies, there'll be 6 working days. So don't you think if such companies are merged, whether the number of working days will be 5 or 6 is a big cause of concern? Correct or not? Right? So in some companies, work times will be different. Some other companies, working hours would be different. So if you merge, right, so work culture always plays a very important role. So what about work culture? What about salary packages? Right? All of these, right, will also be a cause of concern, because these can create frictions. These can create frictions between the labor force, which is not good for the new entity. So these are some of the concerns which are associated with the concept of a larger bank. larger bank or a big bank in India. Done. Having said so, do we have any kind of reforms associated with this? Right? Is there any reform or any, right, let's say, measure which government of India has taken regarding this? RBI has introduced a methodology called as too big to fail banks. Too big to fail banks. Please remember this concept. Too big to fail bank or too large to fail bank. Now, what is this idea of a too big to fail, too large to fail? RBI says any bank whose size is more than 2% of GDP of India. I repeat, any bank whose size is more than 2% of GDP in India, then automatically they will come under strict regulation of Reserve Bank of India. Is it okay? I'll repeat it again. If RBI says if any bank becomes very large in size, then RBI will impose additional regulations, more regulations on these banks. They will not reduce regulations. They will impose more regulations on such banks. Such banks are called as a too big to fail banks. Done? Right. So these are some of the advantages or disadvantages or concerns associated with the concept of larger bank or basically a big bank in India. Done? Can we go forward? Employment concern is not understood. My dear, if banks are merged, company or let's say the bank will not require same number of employees. They will not require same number of employees. Some of the employees will be losing job. That is a concern. And if banks are merged from one bank to another bank, work culture will be different, right? The timing hours could be different, the business could be different, right? Their whole idea could be different. So when you merge these kind of banks, there could be friction, there could be inefficiency in the labor force. Okay. Okay, let me go forward now. Concept of lending rate regimes. Concept of lending rate regimes. What do you mean by lending rate regimes? Listen carefully. Here is a bank. Here is a bank. Okay. Now this bank will collect money from different sources. It will collect money from different sources and will give loans. Correct? Will give loans to customers. Will give loans to customers. And when the bank will give loan to the customer, it will charge and collect certain rate of interest. It will charge and collect certain rate of interest. I'll call the rate of interest, I'll use a short form here, ROI, rate of interest. Now, on what basis? On what basis the bank will decide what is the rate of interest? That is basically a lending rate. Any problem here? I'll repeat the process here again. Please listen carefully. Some of you are not listening. That's the reason you will ask me, what did you write there? What did you write here? Listen carefully. Step number one, bank will collect money from different sources. All of you okay with this? The bank can borrow from RBI. Bank can take money from depositors, such as individuals, such as companies, etc. And step number two, bank will give loans to customers. And when bank will give loan to customers, it will charge a certain rate of interest. Charge and collect rate of interest. How does it calculate this? That is basically the concept of lending rate practice or lending rate regime. Now, on what basis will they decide? Follow this very carefully. Point number one, cost of capital. What is cost of capital? Listen to me carefully now. Imagine, bank, I'm a bank, I will take a deposit of 100 rupee from you and yearly I will give you 4% rate of interest. Can I call this 4% rate of interest as cost of capital for me? Anybody has a problem here? I'll repeat it again. You are a depositor, you will keep 100 rupees with me and annually I'll give you 4% rate of interest. Can I call this as cost of capital, right, for me? That is, at what price am I borrowing money? Can I say repo rate can be a cost of capital for the bank? Repo rate can be a cost of capital for the bank because bank will borrow from RBI at repo rate. So first one is, what is cost of capital? At what price or at what percentage rate of interest bank has borrowed money? That is called as cost of capital. Second one is, what about cost of operations? What about cost of operations? The bank will hire people, the bank will purchase, right, let's say computers, the bank will, right, hire or take a house or let's say an office on rent, right, they will have to pay electricity bill. What about cost of operations? That should also be included. Third one, what about profits? Don't you think bank should also earn certain profit? So when they give a loan, the rate of interest that they determine or that they charge should include certain profit margin, certain profits. Fourth one, what about cost of CRR? Tell me, how many of you remember this? Cost of CRR. Do you remember the idea for cost of CRR? Right, last week we have discussed this, Friday we have discussed this, right? So bank will collect a deposit, part of it they will keep it with RBI, they will not earn any interest, but to the customer they will pay complete interest. So cost of CRR or negative carry on the CRR. And fifth one, premium. There's a concept called as premium, risk premium, tenor premium, etc. What do you mean by that? A bank will give loan for 1 year, bank will give loan for 20 year. Don't you think in the second loan bank is taking a higher risk? I'll repeat it again. Bank will give a loan of 1 year, bank will give loan of 20 years. So don't you think bank is taking a higher risk by giving longer duration loans? So when they are taking more risk, they will add certain premium. Premium means extra rate of interest, additional rate of interest. So these are generally some of the parameters which are considered by the bank. I repeat, these are generally some of the parameters that are considered by the bank when they will provide loans and they charge a rate of interest. That is called as a lending rate. Okay, can we go forward? What is cost of capital? Bank will collect a deposit, bank will pay rate of interest, bank will take loans under repo, bank will pay rate of interest. All of that is called as a cost of capital. Okay. Now, what are the methodologies? What are the methodologies which are used by the banks to provide loans and charge a rate of interest on it? Right now, the two very important methodologies are: one, marginal cost of funding based lending rate. Second one is external benchmarking. These two are very famous now. Listen carefully. One is a marginal cost of funds based lending rate. Second one is external benchmarking. So before this, what was there? Before this, there was a base rate regime. Before this, right, there was benchmark primary lending rate regime. Before that, there was a primary lending rate regime. So there have been different regimes. But right now, which are the two most important regimes which are used or methods which are used by the banks to determine lending rate? One is a marginal cost of funds based lending rate regime. Second one is external benchmarking. Now, to understand both of them and the concept behind why they have been introduced by RBI, let me add one more concept to you. That is monetary policy transmission. Monetary policy transmission. Now, what is the concept of a monetary policy transmission? Let me explain it. Please listen carefully. Monetary policy transmission refers to what is the impact of change in the interest rate in the overall lending activity in the banking sector. I'll repeat the statement here. Listen carefully. Listen to it. Monetary policy transmission refers to what is the impact of change in the interest rates done by RBI and the impact of that in the overall lending done by the banking sector. How? Let me explain it. Here is Reserve Bank of India. Here is RBI. And here is, right, I'm sorry, here is a bank, not this side arrow mark. Okay, so RBI is there. Here is a bank. Now, can I simply say a flow chart? A flow chart could be RBI will provide loan to the bank will provide loan to customer, correct? RBI will give loan to bank will give loan to customer. Now, if RBI will reduce the interest rates, that is a repo rate. If RBI will reduce interest rates, can I say bank should also reduce their interest rates? And when the interest rates is reduced, what do you think will happen to the loans or the credit issued by the banks? The loans or the credit issued should start increasing. So understand the logic here. Monetary policy transmission means by how much percentage RBI has reduced the interest rates, and as a result of this, what is the percentage by which banks have reduced their interest rate on the fresh loans given. I'll repeat the statement. Listen to me carefully. I'll repeat it again. By how much percentage RBI has reduced interest rates, and as a result of this, by how much percentage the banks which have given new loans, fresh loans, have reduced their lending rate. That is the concept of monetary policy transmission. Now imagine RBI has reduced repo rate by 2%. RBI has reduced repo rate by 2%. Banks collectively on the loans that they have given, if they reduce their interest rate by 0.5%, do you think monetary policy transmission is efficient here? Think of it. RBI has reduced its interest rate by 2%, but the banks have reduced only by 0.5%. Right? Don't you think transmission means what? By how much percentage they have reduced the interest rate? And if they have reduced the interest rate much more, don't you think customers would get the benefit of it? Right? So argument is to what extent the benefit is getting transferred in the loans in the form of lower interest rate. That is called as a monetary policy transmission. And argument of RBI generally has been banks do not follow efficient monetary policy transmission. They are inefficient in it. Inefficient means I will reduce interest rate by a larger number. RBI reduces interest rate by a larger number. Banks do not reduce their lending rate by a larger number. They will reduce it marginally. They will reduce it very, very small number. Right? That is the problem with that. That's a problem that RBI says we don't want the banks to do. If I reduce interest rate, banks should also reduce interest rate. How do I ensure that? How do I ensure banks will also do this? That is the reason in 2016, RBI introduced a new concept called as MCLR. It was introduced in 2016, MCLR, marginal cost of funds based lending rate. Now, under the marginal cost of funds based lending rate, RBI said, please listen carefully. RBI said, I will decide on what parameters banks should decide their lending rate. I'll repeat the statement. RBI said on what basis banks should decide their lending rate. And RBI gave these parameters to all the banks in India. RBI said, these are the parameters on which you will have to decide what is your lending rate. That is marginal cost of funds. Now, many of you will ask me, what do you mean by marginal cost of funds? Cost of funds is nothing but cost of capital. Did we discuss the idea of a cost of capital? That is at what percentage banks are borrowing. Now, what is this marginal? Marginal means even if there's a small variation. I repeat, marginal means small. Marginal, English term, it means a small. Even if there's a small variation in your cost of funds, even if there is a small drop, at what percentage you are borrowing loans, even if there's a small drop in that rate of interest, please transfer that to customers. Reduce your rate of interest. That's a basic idea. Does it make sense to you or not? Why they call this as a marginal cost of funds? Look at the name. Marginal cost of funding based lending rate. Many of you will try to by heart the whole statement. Please do not by heart it. Listen carefully. RBI says the rate of interest at which you are borrowing, you will borrow from customers, you will borrow from right RBI, etc. That is cost of funds for you, cost of capital for you. If that cost of funds will reduce even by a small percentage, even if it changes by a small percentage, do not hesitate, transfer that benefit. Once your cost of funds will come down, you also reduce your lending rate, right? That is the reason. Now look at the name. I'll break the name into two parts. Tell me, does it make sense to you? I will read it like this. I will read it like this. Focus on my pause. Focus where I take a pause and continue. Focus now. Marginal cost of funds based lending rate. I'll repeat it again. Marginal cost of funds based lending rate. Does it make sense to you why it is named like this now? Let me know. Does it make sense to you or not? So first component is a marginal cost of funds. Second one is a negative carry on CRR. Third one is a operational cost. And the fourth one is a tenure premium. Tenure premium. Right? Based on what tenure, for what duration you have given loan, you will be allowed to impose a certain premium. Okay, that is basically concept of MCLR, marginal cost of funds based lending rate. Those who are saying this is very difficult, my dear, please do me and yourself a favor. Do yourself a favor. Go to Google and type what does marginal mean. Do it. Do me a favor. Do yourself a favor. Go to the Google and type what does marginal spelling is there right in front of you. Marginal mean. Google will tell you marginal means incremental or small. Okay, it will simply tell you marginal means very small, very limited change, very small change, which means have a look at this. If right, if this is the bank will borrow, let's say from RBI, right? If RBI will reduce the interest rate by very small number, if RBI will reduce the interest rate by a very small number, then under MCLR, the bank should also transfer the benefit to the customer by reducing its rate of interest. That is basically the concept of MCLR, marginal cost of funds based lending rate. But there is a problem. What is the problem? RBI introduced MCLR, banks did not follow it. Banks, right, basically said, I will consider this as my cost of funds. I will not consider this as a marginal change. I will have this kind of a tenor premium, etc., etc. Which means very simple. Even though RBI introduced MCLR to increase transparency in the system, to make the system much more transparent, to ensure that the monetary policy transmission will become efficient, customers will get the benefit, etc., that did not happen. And that is the precise reason RBI introduced a new concept now, which is there in the place, which is called as external benchmarking, which is referred as external benchmarking. And how does external benchmarking works out? Please listen to me very carefully. Point number one, benchmark. Understand the meaning of the term first. Benchmark means connect. Benchmarking is nothing but connecting, right? Or else they will also use the term indexing, right? Many of you would have not heard the term indexing, hence I'm using the term connect. Benchmark means connect or a standard. Now, how does this external benchmarking will work out? Let me discuss it. Listen carefully first. Imagine here is a bank. Imagine here is a bank. I've taken a housing loan. This bank will calculate a rate of interest like this. They will say housing loan will be having a rate of interest that is repo rate plus, let's say, 2.5%. Let's say hypothetically, the rate of interest on housing loan will be repo rate plus 2.5%. And let's say hypothetically, imagine, let's say repo rate right now is 5%. So now tell me what will be the rate of interest that I will pay on my housing loan. I'll pay 5% plus 2.5%. All of you will agree I'll pay 7.5%. Correct? Now, if RBI will change this repo rate from 5% to, let's say, 4.5%, that is one possibility. Or RBI will change the rate of interest from 5% to 5.5% also. What is the impact? Impact is that automatically, I repeat, automatically RBI says banks will have to change the rate of interest. When the rate of interest will reduce to 4.5%, my rate of interest on the housing loan will become 7%. All of you okay with the calculation? Sir, how it will become 7%? 4.5% plus 2.5%. And if RBI will increase the repo rate from 5% to 5.5%, the bank automatically will change the rate of interest on my housing loan to 8%. So now tell me, point number one, can I say repo rate is external to a bank? External means bank doesn't fix a repo rate. It is fixed by RBI. All of you will agree? RBI fixes repo rate, not the banks. So banks are connecting their lending rates to an external parameter. Banks are linking their loans, that is the rate of interest on the loans, to an external parameter. This process is called as external benchmarking. This is very famous now. This is very, very famous. For example, if any one of you has taken a housing loan, please check the loan document. You will see this kind of rate of interest given by the bank. Please check it. If you have, right, if you don't have a housing loan, if your parents have, please ask them. Please ask them, simple, ask them only one question. Has the rate of interest on the housing loan in the last 1.5 years, has it increased or decreased? Just ask a simple question to them. They will say the rate of interest on the housing loan that they have taken in the last 1.5 years has increased. And you'll be wondering why? Why has it increased? Then check what has been done by RBI in terms of repo rate. From the last year, April, May, please check what has RBI done for repo rate. Has it increased or decreased? You will see that overall I'm talking, overall RBI has increased the repo rate. So now tell me, if overall RBI has increased repo rate, does it make sense when the borrower also says their rate of interest on the housing loan has increased? Yes or no? Does it make sense to you? When the borrower says my rate of interest on the housing loan in the last 1.5 year has increased, why is it so? It is precisely because repo rates have been increased, which means the banks have connected this housing loan rate of interest to the repo rate. So once the repo rate starts increasing, right, the housing loan interest rate will also start increasing. This is called as external benchmarking. I'm saying this with conviction. I'm saying this with confidence for a very simple reason. I have a housing loan. I hope you understand. I have a housing loan. So I know what has happened to my loan rate of interest in the last 1.5 year. And it is not going to come down. In the next couple of months, it is not expected to come down. Right? It will remain elevated. Repo rates are not expected to come down in the next couple of months. Done? So now can I say, if RBI will impose this, and it has already been done, if RBI will implement it, it will make rate of interest calculations much more transparent. Yes or no? It will make rate of interest calculations by the banks, of course, lending rates much more transparent, because you know why the bank has increased its lending rate. And RBI now says, please remember one more point, RBI now says this this lending rate calculation has to be done once every 3 months. Once every 3 months, every bank has to calculate this. No other option to them. Because there is also a possibility that when RBI will increase the repo rate, they will calculate it immediately, right? Increase the loan, rate of interest on the loan that you have taken. If RBI reduces the repo rate, they will wait for 6 months. They will wait for 12 months to calculate and reduce the rate of interest on the loan. So RBI says once every 3 months, that is Once in a quarter, every bank has to calculate it. Every bank has to adjust for the new repo rate. Their lending rates have to be adjusted so that the benefit either increase or decrease, the benefit will be given to the customers. So the system is much more transparent. You as a customer, you know how they are calculating, right? If the interest rates will go down, you will get the benefit. If the interest rate goes up, you will have to pay more rate of interest. So this is a concept of external benchmarking. And please remember, this has been recommended by a committee, Janak Raj Committee. There is a committee set up by RBI, Janak Raj Committee, and this concept of external rate benchmarking has been recommended by Janak Raj Committee. And second point, RBI says you have different options. You want to link your lending rate to repo rate, you can take it. You want to link it to, let's say, yield rate of 91-day treasury bills, you can link it. You want to link it to 182 days of treasury bills, you can link it. Or if you want to use a new parameter, there is one institution in India by the name of FBIL, Financial Benchmarks of India Limited. I repeat, FBIL, Financial Benchmarks of India Limited. So that is one institution. If you want to use any of the indicators that is published by FBIL, you can also use it. Most of the banks, I repeat, most of the banks have chosen repo rate. Most of the banks have chosen repo rate itself. Done? Can we go forward? Can we go forward? Right. So that is the discussion regarding the concept of the lending rate regimes. Now, let me take a break. But before the break, any questions that you people have, any doubts you have, please do let me know. Can you explain ICRR? ICR, incremental CRR, right? The CRR, incremental CRR. Why did RBI introduce ICRR? Reason is very simple. Once RBI announced that 2000 rupee notes will not be used after September 30th. Right? I repeat, once RBI announced that after September, 2000 rupee notes we will not allow them to be used. RBI was concerned that lot of customers will take the 2000 rupee note and they will deposit that in the bank. Understand the logic behind it? They would deposit that in the bank. And these deposits are not permanent. I hope you understand, these deposits are not permanent in nature because you have announced, because RBI has announced withdrawal of 2000 rupee note. That's the reason that 2000 rupee note deposits will increase. So RBI was basically concerned that the deposits held with the banking sector will suddenly start increasing. That will put a lot of pressure on the banking sector. So RBI said, whatever deposits you are going to collect after a certain date, we will collect that under the concept of CRR. Right? That is the reason they call this as an incremental CRR. Okay. In RBI balance sheet, schedule section is for what purpose? What schedule section? Don't worry about schedule or sections under RBI balance sheet. As sir mentioned, if people will keep money in a demand deposit, then M1 will increase and M3 will decrease. But in formula M3, M1 plus time deposit in the banking sector, M1 decreases, then M3 will also increase, then thus negating above statement. My dear, it's a comparison. For example, let's say compared to last year, if M3 will fall down, let me know. Compared to last year, if M3 will fall down and compared to last year, M1 will start increasing. That means people are saving more and more deposits for consumption purposes, and their savings in the form of future consumption has come down. That was a comparison I was making. Okay. What will happen if post offices were closed or privatized? Again, you don't know what is going to the impact, right? Because post offices are not just the working as a post offices. They are providing a lot of financial instruments to rural poor, right? So there is a lot of issue related to closing of post offices in India. Variable repo rate, again, don't worry. Whenever RBI will conduct these repo operations or reverse repo operations, they can conduct it at fixed repo rate or variable repo rate, right? So basically, whether the repo rate will be fixed as per the proposal or it will be changed. A variable means changed. Okay. Tenor premium means whenever you give a loan for a longer duration, you are taking a higher risk obviously you are going to charge a higher rate of interest. Repo rate and marginal cost of funding rate are same. My dear, marginal cost of funding, do you think it is only repo rate through which banks will borrow in the market? Think of it. Please think of it. Do you think it is only the marginal rate? I'm sorry, it is only the repo rate through which banks will borrow? No, they will collect your deposit. That is also borrowing. So there are so many rates of interest which bank will pay to the customer. Right? Overall, what is the change? That is a marginal change. Okay. Then MCLR have tenor premium, right? Every loan that they provide, please understand, whatever loans they are providing, they will consider tenor premium. Tenor will be included in the calculation by default. Okay, done. So let me take a break now. We'll restart the discussion at 7:20. Right, we'll restart the discussion at 7:20. Take a break. We'll restart the discussion 7:20. Okay. Am I audible? Can we start? Am I audible? Please do let me know. Let's start. So the next concept, technical. Please listen carefully. Basal guidelines. Slightly technical. Many of you will feel this is very difficult, but please listen carefully. It's a simple concept. What is required for UPSC will understand only that. Now, whenever you talk about a bank, there is a term called as total capital. I repeat, whenever you talk about a bank, lending institution, there's a term called as total capital. What is total capital? It is how much is the total assets plus money that the bank has. Now, this total capital of the bank is the sum total of tier 1 capital and tier 2 capital. That is, the capital of the bank is generally divided into two parts, right? Tier 1 and tier 2. Now, what is a tier 1 capital? Tier 1 capital is called as a core capital. Tier 2 is called as a supplementary capital. Listen carefully, slightly technical. Once you understand, all of this is very easy. Again, basics more than sufficient. Now, let's say here is a bank. Okay. Let's say here is a bank. The bank will have certain capital. Let's say I'll take simple numbers so that you understand. Let's say 600 rupees. I'll call this as tier 1 capital. Just to make you understand, I'm taking simple numbers. Okay. Second, another 600 rupees, which is called as a tier 2 capital. Now, many of you will ask me, sir, what is the use of the tier 1 capital as well as the tier 2 capital? What if the bank incurs a loss? Let me know. What if the bank incurs a loss? Don't you think bank should have money to absorb losses? I'll repeat statement. Please participate and do let me know. I'll repeat the statement. Imagine here is a bank. Bank has tier 1 capital of 600 rupees and tier 2 capital of 600 rupees. Total capital in this example will be 1200. Now, what is the use of the capital? What is the use of the capital for the bank? Can I say bank should have sufficient capital in case the bank will incur losses, it will use the capital to absorb losses? Correct? All of you okay with this? It will use this capital to absorb losses. That is the importance. But why do we divide the capital into two parts, tier 1 and tier 2? Please remember this. Tier 1 capital has a more absorption capacity. It is better at absorption of losses compared to tier 2. I'll give you examples, so listen carefully. Between tier 1 and tier 2, tier 1 can absorb losses much more sooner, much better compared to tier 2 capital. Now, many of you ask me, how is that possible? How is that possible? I'll give you a very simple example. What if I say, here is a company, just a parallel example to make you understand. Imagine here is a company. I'll say company can use a certain amount of capital if they incur losses to absorb losses. Second, company also has certain amount of capital if they incur losses and they are about to shut down. Understand the differences between both of them. Please understand the difference. I'll repeat it. The company, I'm talking about this part, by the way. Those who are wondering which part I'm talking about this part. Okay. Let's say the company is there. The company has certain capital, that is money. Money is there with the company. One certain amount or certain part of the amount, they can use it whenever they incur losses to absorb the losses. And second, they can use the other part of the money whenever they have incurred losses and they're about to shut down in the economy. So can I say in these two examples, right, the first part of the capital is better at absorbing losses. Everybody is okay? The first part of the capital is better at absorbing losses. Why? You are not about to shut down. You're not closing. You have just incurred losses, you can use this money. But on the other side, there is some other amount, some other capital, you can use that capital also, but you are about to close down now. You are about to shut down the operation. All of you can understand the difference between both the types of capital. Why I'm talking about all of this? In textbooks, in let's say bigger documents that you will start reading after, right, we discuss Basel, etc., they will say Basel, right, tier 1 capital is going concern capital. Going concern capital. And tier 2 capital is a gone concern capital. Gone concern capital. Meaning what? Whenever you incur certain amount of losses, you can use a tier 1 capital to absorb losses. But second, tier 2 capital, you can use it when you are about to incur bankruptcy. Bankruptcy means you are about to shut down. All of you are okay with this? Can we go forward? Capital means what? Money. Money in the form of assets, money in the form of cash, etc. How much is the total capital of the bank is divided into two parts, tier 1 and tier 2. Again, I'm repeating it. Tier 1 capital can absorb losses much sooner in a much better way compared to tier 2 capital. Because tier 1, you can use it whenever your losses will reach a certain level. Tier 2, you can use it when you're about to incur bankruptcy. Bankruptcy means you have no other option now. You might have to shut down the company. That is the reason, again, I'll repeat it. Tier 1 capital is much better, much more reliable compared to tier 2. Right? So remember this very carefully. Now, tier 1 capital, that's the reason it is called as a core capital. Sir, any example of it? Any example of tier 1 capital? Bank will issue shares, collect money from the shareholders. All of you heard of this? Banks such as Bank of Baroda, such as right SBI, they will issue shares and they will collect money from the shareholders. That is one example. These banks are also allowed to issue bonds. I'll discuss this now. These are also allowed to issue bonds, collect money from the investors in the bond. In case of a tier 1, the banks are allowed to issue a bond by the name of additional tier 1 bond. I'll discuss in a minute. In case of tier 2, the bonds that are issued by the banks are called as tier 2 bonds. So any banks in India, have they issued these kind of bonds? Dana Bank has issued these bonds. Right? Have you heard of Yes Bank? Let me know. Have you heard of Yes Bank? Right? Yes Bank was very famous for this. Yes Bank has also issued such bonds. SBI also has issued certain bonds, right, related to Basel only, etc. Now, very interesting. Some of you basically say whatever question I ask, you say no, no, no. My dear, then my concern is, why are you not reading current affairs? Let me know. Why are you not reading current affairs? This is a very, very clear indication that you are not reading current affairs. Otherwise, many of you will say, sir, you are wrong. It was not mentioned in the newspaper, etc. Do me as well as yourself one favor. After the class is over, type Yes Bank and let's say plus tier 1 bond plus a Supreme Court, and just check in the Google how recently in the last couple of months this was there in the discussion. Please check it. Okay, now let's start. Tier 1, additional tier 1 bond, tier 2, tier 2 bonds. Now, let's start. Let's understand what is this additional tier 1 bond and tier 2 bonds. Okay, now, right, listen very carefully. Both are very important. Point number 1. There is a concept of secured bonds as well as unsecured bonds. Okay, there is this concept of secured as well as unsecured. What is the meaning of secured and unsecured? Let's say hypothetically, I'm issuing this particular bond to you. Your friend is back. Okay. I will issue this particular bond to you and I will tell you, if I don't repay this amount after 3 years, you can take away my home. All of you okay with this? I'll repeat the statement. I will give this particular bond to you, right? I will collect 100 rupees. Now you will ask me, sir, what if you don't repay my 100 rupees? Then I'll simply say, if I don't give you, take away my home, sell it and get your money. These are called as secured. These are called as secured. Now, in this context, let me ask you a very simple question. In recent times, in the last 1 week, was there a discussion regarding unsecured loans raised by Reserve Bank of India? Let me know. Right? Was there a discussion regarding unsecured loans very recently raised by Reserve Bank of India? In fact, it was there. Suddenly, UPSC can ask you this. Please be very careful. Please be very, very careful. What do you mean by unsecured loans? Unsecured bond, unsecured loans means there is no security. There is no asset provided as security. There is no asset provided. There is no security provided. For example, many of you ask me, is there any example? Have you heard of educational loans? Have you heard of educational loans? Educational loans are unsecured in nature. Educational loans are unsecured in nature, right? So I hope you understand. Very recently, RBI has raised a concern that banks have started providing more of unsecured loans. And the problem is that if you provide unsecured loans, definitely yes, you will charge a good rate of interest. What if the borrowers don't repay it? What if the borrowers do not repay it? Then that is the concern which has been raised by Reserve Bank of India very recently. Please be very, very careful. UPSC suddenly can take a question on it. Okay? Right? Now come back to this. What is an unsecured bond? Apply the same logic. What is unsecured? Unsecured bond. Unsecured bond means same. I will issue this particular bond to you. I will issue this particular bond to you, and I will not give you any security. I will not give you any collateral. That is called as unsecured bond. Okay? Right? So again, please understand. Secured, unsecured, what kind of loans are there? Right? Generally, not always. Right? Please understand my statement. Not always. Personal loans, there are unsecured loans. Not always, again, right? Within personal loans also, they can collect security. For example, some of you are saying, sir, but in my loan, I've given this, I've given this. Again, what kind of loan you have taken, right? Which bank you have approached, right? Etc. What were the condition? They can keep on changing that. Okay. So secured loans are there, unsecured loans are there, right? There is no guarantee that this loan is always secured or unsecured always. It differs from one situation to another situation. Now come back to the point here. I said in context of Basel guidelines, there is right two types of bonds that the banks are allowed to issue and collect money. But please listen to me very carefully. Both the types of bonds that I'm discussing here, that is a tier 2 bond as well as additional tier 1 bond, both are unsecured in nature. Both are unsecured in nature. That is, the bank which is issuing it, it doesn't provide any collateral. No security is given for this particular bond issued by the banks. Point number 2. Let me start additional tier 1 bond. Please tell me, when I say this bond I'm issuing to you, can I say there is a maturity period already decided for the bond? Can everybody see this particular bond that I'm holding in my hand? There is maturity period which is already decided for the bond. What is the maturity period? 3 years. The issuer is deciding the maturity period. But remember this, in the context of additional tier 1 bond, in the context of additional tier 1 bonds, there is no maturity period. There is absolutely no maturity period. Now, many of you ask me, how does that work then? Right? What do you mean by no maturity period? I will tell you. Imagine this is a bond. Okay, this is a bond. 100 rupee and 6%. Right? Can you see a maturity period? No maturity period. I have hidden it. Correct. The maturity period is not visible. I'm hiding the maturity period. So I will issue this particular bond to you. I will collect 100 rupees from you. I will give you 6% rate of interest. Now I will decide when I want to repurchase it back from you. Is it okay? I will decide. I might repurchase it after 5 years. I might repurchase it after 10 years. Right? That is very, very important feature associated with additional tier 1 bond. Is everybody okay with the two features? I'll go to the third feature now. Right? First feature is this additional tier 1 bonds, right? These are unsecured in nature. Second one is there is no maturity period. The bank will simply issue it to you, and they might purchase it after 5 years, after 10 years. You cannot force the bank to purchase it. Third very important feature, whenever the banks are facing a crisis, let's say the bank will incur certain losses this year, then the bank can approach Reserve Bank of India and tell RBI, I will not be able to pay interest to the customers. Or if the crisis is much bigger, the bank might simply approach RBI and say, I've issued this particular bond to the customer. Okay, I'll hide this maturity period. I've issued such a bond to the customer, but I will not be able to repay the principal amount as well. Is it okay? I've issued this particular bond to the customer. I will not be able to pay principal amount as well. Meaning what? The bank will simply say, you might have given 100 rupee to me. I will not return the 100 rupee. Forget about interest. I will not pay interest. I will not even return your principal amount back. These are the features associated with additional tier 1 bond. Anybody has a problem with this? Let me know right now. Anybody has a problem with the features of additional tier 1 bond? Can we go forward now? Arey Baba, either say yes or say no. Nobody is replying. Everybody has become dormant. Okay, all of you okay with the features? Second point. First point, a second point. Okay, I have discussed 3 points. You are asking me to discuss all the 3 points again. I'll repeat it. Listen carefully. First point. These are unsecured. Unsecured means no collateral, no asset is guaranteed. Second one, the bank does not tell you what is the maturity period. They will simply say, purchase this bond. Correct? Can you see this? They'll simply say, purchase this particular bond. I will give you 6% rate of interest annually. I might purchase it after 5 years. I might purchase it after 10 years. There is no guarantee, but I might purchase it. Third one, if the bank is incurring lot of losses, then it can approach RBI and tell the RBI, because I'm incurring losses, I will not pay interest to the customers who are holding this bond. That is one possibility. Or if the losses incurred by the bank are large enough, very large enough, then the bank might simply say, I've collected 100 rupees by issuing this bond. I've collected 100 rupees by issuing this bond. I will not return the 100 rupees. I will not simply return the 100 rupees. That is called as writing off. All of you are able to understand this? That is called as writing off, simply cancellation of the bonds. That is also the feature of additional tier 1 bonds. Done? Now, because of these risky features, don't you think the coupon rate or interest rate on additional tier 1 bonds will be higher? Correct or not? Because of these kind of risky features, the coupon rate or interest rate on such bonds would be very high. That is the reason why investors generally invest in such bonds. This is the reason why investors invest in such instruments. Now, many of you are saying this is fraud, this is that, this is that. My dear, this is market. This is market. By investing, don't you think you are taking a risk in the instrument? Yes or no? You please tell me. By investing, are you not taking a risk in the market? Of course, yes. So you want a higher returns, but you do not want to take a risk. Which market will provide you that facility? You please tell me. Let me know. Right? Which market will provide you that facility wherein you do not want to take any risk, but you want very high returns? Nowhere they will provide you this kind of a right? No risk and very high returns. Higher the risk, higher the returns. So you know that the bank, if they incur losses, they might cancel your bond. You know that there is a risk, is there? That's a reason they are offering a higher interest rate. That is a catch for them. Generally, this is how the market will work out. Okay. Now, next one, tier 2 bonds. Let me go to tier 2 bonds. Tier 2 bonds, one, these are unsecured, just like additional tier 1, these are unsecured. Second one, the issuer will decide what is the maturity period. Meaning what? Please tell me. Compared to earlier example, now when I'm issuing the bond, is the maturity period decided? Let me know. Compared to earlier example, 5 minutes ago, I'm issuing one more bond to you now. Is the maturity period already decided? Please look at the cardboard first. Some of you are saying no. Why, my dear? Is the maturity period decided or not? Arey Baba, you people are not seeing. You're not even reading cardboard now. Is the maturity period already decided? Yes, maturity period is decided. So unlike earlier situation where the bank might purchase it after 5 years, now there is no right. There is no situation like this. It simply says the bond will have a maturity period of 3 years. More certainty. More certainty. I'm not saying this is risk free. Please understand. I'm not saying this is risk free. I'm saying compared to tier 1 bond, is there certainty of banks purchasing these particular bonds after 3 years? Yes. The maturity period is already decided. But more importantly, please understand this. What if the bank is about to shut down? Not incurring losses. Bank is about to shut down now. Then they can approach RBI and they will simply tell RBI, if I pay the coupon rate for this bond, if I pay the coupon rate for this bond, or if I pay the principal for this bond, I am going to shut down. No option for me. I will incur bankruptcy. I will shut down now. In such cases, this is called as point of non-viability, PONV. This is called as point of non-viability, PONV. Whenever the bank reaches point of non-viability, that is, they are going to incur bankruptcy now. Now RBI will allow these banks to write off tier 2 bonds. Write off tier 2 bonds. So understand the logic behind it. The banks can write off additional tier 1 bonds much sooner compared to tier 2 bonds. So don't you think banks will rely more on tier 1 capital? Is it okay? I'll repeat the statement here again. Listen to me very carefully. I'm saying banks can write off both tier 1 capital as well as tier 2 capital. But I am saying banks can write off tier 1 capital much sooner compared to tier 2 capital. That is the reason banks will rely more on tier 1 capital compared to tier 2 capital. Okay? Now, having understood this, all these are basics. Some of you are asking, is it relevant for UPSC? My dear, yes. All of these are relevant. Why? To understand, there's a concept called as capital adequacy ratio, CAR. In case of, let's say the Basel guidelines, there is a concept of capital adequacy ratio. To understand capital adequacy ratio, you are supposed to understand all of it. We'll go to that. Have patience. Let's start. All the banks will face three types of risk. Please understand this carefully. All the banks now will face three types of risk. Right? One is called as a credit risk. Second one is market risk. Third one is operational risk. Let's start with credit risk. A bank will give a loan. What if the borrower doesn't repay the loan to the bank? Don't you think because of that, bank will incur losses? Simple question I'm asking you. Please participate. Listen carefully. Participate. Once you understand this, it becomes a game for you. I'll repeat it. Bank will give a loan. The borrower doesn't repay the loan to the bank. Can the bank incur losses because of this? Yes. This is called as a credit risk. This is called as a credit risk. The potential that a bank borrower will fail to meet obligations according to the agreed terms. First one. Second one, market risk. Second one is market risk. Now let's say hypothetically, the bank will purchase a bond at 100 rupees. The bank will purchase a bond at 100 rupees. Now the bank is facing lot of issues. They need cash. They will go to the market, sell a bond, but the market price is 90 rupees now. Is it not a market risk faced by the bank? Let me know. Is it not a market risk faced by the bank? Some of you are saying no. Listen carefully, my dear. You will purchase the bond at 100. After some time, you will go to the market to sell it at 90 rupees. Don't you think the movement in the market is affecting your returns? Yes or no? Movement in the market, is it not affecting your returns? You spent 100, you are earning 90. Is it not market risk? Right? So that is market risk. So banks will also face a lot of market risk. Third one, operational risk. Third one is operational risk. I'll give you two examples. Okay. Let's say I'm a cashier. You will come to my branch, deposit large bundles of, let's say, 2000 rupee notes or 500 rupee notes. I am running late, right? It's already almost lunchtime. I want to go to lunch. So in the hurry, I will just count the number of currency notes and I'll take it as a deposit. I will put it in the I'll put it in the chest, currency chest. But later I'll come to know one of the 2000 rupee currency note that you have deposited, it is fake currency note. Tell me, is it a loss for the bank or not? Let me know. Is it a loss for the bank or not? Of course, yes, it's a loss. I'll give you one more example, then we'll connect it to current affairs. I'll give you one more example. Now, earlier what used to happen, imagine you have a 500 rupee note, you wanted to convert that into coins. I'm connecting to current affairs, please listen carefully. You have 500 rupee note, you want to convert that into coins. Earlier, you could go to a branch, right, convert that into coins, or else there were machines, right? The banks used to install certain machines where you could go, you could deposit that particular 500 rupee note into the machine, and right, the change, right, coins would be given to you. That was basically the system. Now this is what RBI says. RBI said that in many instances, people have deposited fake currency note and the machine has given coins to them. Very simple. In many instances, people have deposited fake currency note and the machine has given them a coin. Right? That is change in the form of coin. Now, please tell me, if you deposit a fake currency note into a machine and in return get changes, right, in 5 rupee, 10 rupee, etc., is it a loss for the bank or not? Is it a loss or not? Of course, yes. You have given a 50 rupee fake currency note, you have taken, right, coins from them. So it is a loss. Now, this used to happen earlier. Why I'm talking about all of this? Right, the first example and the second example that I gave just now, this is called as operational risk. This is called as operational risk, or else it is also referred to as systemic risk. Systemic risk, right? What is an operational risk? Whenever the bank will face a risk because of the systems, because of the people, right, etc., that is called as an operational risk. Now, what has RBI done? This is a problem for the banks. You know this now, I know this. What has RBI done? Very recently, RBI has introduced a system called as QR code based coin vending machines. Coin vending machines. Very, very famous now. Please be very careful. QR code based coin vending machines. Now, what will happen in QR code based coin vending machines? New type of machines have been installed. Now you do not have to deposit money. You cannot deposit money in the machine now. All you need to do is, right, a QR code will come. You need to scan the QR code from your account. I repeat, from your account, money will be cut. money will be debited. And after that, you can withdraw coins from the machine. All of you okay with the system? I'll repeat it. Right? The QR code will be displayed. You need to scan, and money will be cut. Money will be debited in banking language. Money will be debited from your account, and after that, you can withdraw the coins from the machine. Right? This is called as a QR code based coin vending machines. Remember these concepts. Why I'll tell you. Remember these concepts. Can I say by using these kind of measures, we can reduce the risk of losses faced by the bank? I'll repeat the statement. Okay. By using such measures, can we reduce risk of losses incurred by the bank? And surprisingly, some of you are saying no. Why no? Why? Why are you saying no? Tell me. Right? Imagine you are the bank. Instead of giving your fake 50 rupee note in the machine, now notes will not be accepted. Right? QR code will come. I'll scan. Money 50 rupee will be debited from my account. Is there a scope of me giving a fake currency note to you? Correct? Is there a scope of giving a fake currency note? No. So don't you think by using such measures, probability of losses because of this risk will be reduced for the bank? So understand the logic behind it. Okay. Right. So this is one more concept I just wanted to attach with the idea of a operational risk. Now, over a period of time, RBI has taken a lot of measures to address the issue of credit risk also, to address the market risk also, to address the issue of operational risk also. It has taken a lot of measures. For example, I don't know how many of you heard of IBC, Insolvency and Bankruptcy Code. How many of you heard of it? If a bank is facing a credit risk, borrower doesn't repay, now the bank can simply drag you to an authority called as NCLT, National Company Law Tribunal, to recover the money. Is it not a policy to address the issue of credit risk? Right? So I hope you understand a lot of measures have been taken in order to address credit risk, market risk, as well as operational risk. Then all the three types of risk are faced by the bank. Now, next concept. Right? Next concept, risk weighted assets as well as capital adequacy ratio. Last two basics. After this, we'll enter into Basel guidelines. Okay. Risk weighted assets as well as capital adequacy ratio, or capital to risk weighted assets ratio. Now, point number one, I'll ask a very simple question. Please do let me know. Participate and please do let me know. Do not worry about the table here. I've given the table. Don't worry. Let's start. Imagine bank has given loan of 50,000 rupees to government of India. And bank has given loan to, right, let's say, to a business. To another business. Bank has given loan 3, let's say, for real estate. Now, simple question to you. Please think of it and do let me know. When the bank will provide loan to the government, don't you think that is the safest loan with very low risk that the bank can provide? All of you will agree? Anybody in the classroom who says, no, sir, that is very, very risky to give loan to government of India? Then I'll simply say, my dear, please check. After independence, there have been no instances where government of India has taken the loan and has not repaid it. There is no instance. Government has always repaid the loan, which means, can I simply say the first type of loan will carry 0% risk? Let me know. Risk weightage, can I say it will carry 0% risk? On the other side, businesses, I've given to certain businesses that might carry 50% risk. I've given to real estate that might carry 80% risk. Right? So I hope you understand under Basel guidelines. Don't buy heart all of it. It's of no use to you. Under Basel guidelines, different types of assets are given risk weightage. I repeat, under Basel guidelines, different types of loans are assets for the bank. Different types of investments are also considered. So different types of right investments like this or loans like this are given risk weightage, and they will calculate how much of the total assets of the bank are risky. For example, look at the table here. First loan 50,000 rupees, risk weightage is 0%, which means how much of this asset is risky? 0 rupees. Second one is 30,000 rupee, 50% is risky, which means out of that 15,000 asset is risky. Third one is 20,000, out of that 80% is risky. I'm saying out of 20,000, 16,000 rupees is risky, which means out of the total assets of 1 lakh rupee issued by the bank in this example, out of total assets of 1 lakh rupees, 31,000 rupees are risky assets. All of you okay with this calculation? Again, please do not worry about calculation. Right? Some of you are worried about calculation. Please don't worry. Trust me in this. Because Basel guidelines are not new. From 1988, I repeat, 1988 Basel guidelines are under implementation. Please check how many calculations has UPSC asked. None. No calculations have been asked by UPSC. But logic is simple. All the loans are not the same. Risk is there. We are calculating how much of the total assets are risky. And finally, last formula for you. Using this, we'll calculate an indicator called as capital adequacy ratio. This is the last one. Okay. So capital adequacy ratio, or else this is also referred to as CRAR, that is a capital to risk weighted assets ratio. Formula is very simple. In the numerator, you will write total capital of the bank divided by risk weighted assets of the bank into 100. Which means, let's say hypothetically, your capital adequacy ratio, let's say, is 9%. Right? I repeat, imagine your capital assets ratio, I'm sorry, capital adequacy ratio is 9% or capital to risk weighted assets ratio is 9%. What does it mean? It simply means for every 100 rupee, of risk weighted assets, you have a capital of 9 rupees to absorb losses. Is it okay? I'll repeat it again. What does it mean? For every 100 rupee of risk weighted assets that the bank has a capital of 9 rupees. Now, don't you think, look at the situation and please do let me know. Don't you think if the bank's capital adequacy ratio will increase from 9% to 15%, don't you think this is working in favor of the bank? Bank is much more, or bank is in a much higher position to absorb more losses now. It is in a stronger position to absorb more losses because the capital available at the bank is much, much higher. What if it will increase from 15% to 18%? The bank has more capital to absorb losses now. So that is the reason. Please remember, all of you will agree if I say, if the capital adequacy ratio or CRAR of the banks will start falling down, it is a cause of concern. I'll repeat the statement. If CRAR or CAR for a bank will start falling down, it is a cause of concern. Why? It simply shows that the bank doesn't have sufficient capital to absorb the losses. If the capital adequacy ratio will start increasing, it simply shows that bank has more than required capital in case there is a losses incurred by the banks. Right, so that is the reason. Please be very, very careful. This can be asked in UPSC. Capital adequacy ratio once has been asked by UPSC. Its basic logic is that how much capital should be maintained, how much should be the minimum capital maintained by the banks in order to absorb losses. That is capital adequacy ratio. Is it okay? I'll repeat it again. How much should be the minimum capital maintained by the banks in order to absorb losses? Now, please let me know, does it make a sense? Does it make sense to have same capital adequacy ratio for all the types of banks in India? All the types, I'm not asking all the banks, all the types of banks. Right? Don't you think from one type of a bank to another type of a bank, different CAR should be applicable? That is the reason. Please remember this. For different banks, a different CAR is applicable in India. For example, payment banks. In case of India, payment banks. For payment banks, capital adequacy ratio is 15%. Is it okay? I'll repeat it again. For payment banks, what is a payment bank? Why it is so risky? We'll understand that tomorrow. We'll cover the payment bank tomorrow. Don't worry. So for payment banks, it is 15%. For commercial banks, it is 9%. For public sector banks, it is 12%. Why? Logic is simple. From different banks, right, to one different bank, set of banks, risk associated is different. So we cannot have a uniform car, right? We will have a different rates of car applicable to all of them. Okay. So that is basically the different concepts which are associated with the idea of a Basel guidelines. Now let me enter into what is a Basel guidelines. We have discussed the concepts. Now just application of the concepts. Let's go one set to the next one. First one, Basel. Many of you are asking, sir, you have written in capital. What is the expansion? My dear, just to emphasize a lot, I've written this in capital, but remember this. Basel, it's a name of a place. Okay. Basel, it is a name of a place, right? In Switzerland, there is a place, city by the name of Basel. And why this particular city is so important? Basel, there is one institution in Basel that is called as Bank of International Settlement, BIS. Bank of International Settlement. India is one of the members of BIS. All of you okay so far? India is one of the members of BIS. And within this Bank of International Settlement, there is one committee which has been formed, and the name of the committee is Basel Committee on Banking Supervision. Basel Committee on Banking Supervision, BCBS, Basel Committee on Banking Supervision. And this Basel Committee on Banking Supervision, what is the role of it? What is the function of this committee? The Basel Committee will not give recommendations to the government as to how they are supposed to spend, how much should be their right subsidy, etc. No, that is not the role of the Basel Committee. The Basel Committee every now and then will keep on coming out with guidelines in order to promote health of the banking sector. I'll repeat it again. The Basel Committee on Banking Supervision every now and then will come out with set of guidelines to maintain and promote the health of the banking sector. Their focus is purely banking sector. They will not talk about government. Now, so far, the Basel Committee has given three sets of recommendations, which are very famously referred to as Basel 1 Committee, Basel 1, Basel 2, and Basel 3. We have implemented Basel 1 as well as Basel 2. We are in the process of implementing Basel 3 guidelines. We're in the process of implementing Basel 3 guidelines now. Now, what were these guidelines? What have they recommended under this? Let's start. Point number one, Basel 1. I'm talking about Basel 1 now. Basel 1 was announced back in 1988. India, right, that is RBI, has adopted and implemented Basel 1 by 1999, which means India, can I say, is Basel 1 compliant. Let me know. Can I say India is Basel 1 compliant, which means we have implemented Basel 1 guidelines. Now, what was given under Basel 1? Just two very important points. Just remember this. First one, Basel 1 found that, or basically advised that, banks face credit risk. Banks face credit risk. Right? But in fact, a couple of minutes ago, what we have discussed, banks will face credit risk. Banks will face market as well as operational. Right? They will cover those also in some time. So banks will face credit risk. And because of the credit risk, banks might incur losses. Now, to absorb the losses, banks must maintain 8% of risk-weighted assets ratio under capital adequacy ratio. Any problem with this? I'll repeat it again. Only 2 points. What is the first point? Banks face a lot of credit risk. Second one is, because of credit risk, banks might incur losses. Now, how do you absorb these losses? Maintain minimum 8% of risk-weighted assets under capital adequacy ratio. That was the recommendation of Basel 1 guidelines. We have already implemented it. Right? And before I go forward, please understand this. Some of you will basically say, sir, you said in India it is 9%, but in the slide you have said it is 8%. I'll give a very important point. Please listen to me. Don't be confused. RBI has the power to change these numbers. These are recommendations, right? I'll repeat it. RBI has the powers to change these numbers, right? Because international standard, they will say 8%. RBI will simply say, I don't want 8%. I want banks to follow 9% in India. Correct. Does it make perfect sense to you? So RBI has the power to change it. So in the books or in the newspaper or somewhere else, if you come across the number 9%, don't be confused. Recommendation is 8%. We in India have implemented 9%. Nothing wrong with that. Okay. So this is a first set, Basel 1 guideline. Now after the right after a couple of years, again, one more set of reforms were announced. Basel 2 guidelines were announced back in the year 2004. Now, what is the change that has happened from Basel 1 to Basel 2? Point number one, listen to me very carefully. In Basel 1, they identified only one type of a risk. Now, under Basel 2, instead of one, they will say there are three types of risk. Is it okay? I'll repeat it again. Under Basel 1, they identified only one type of a risk. Under Basel 2, we will extend the type of risk to three types of risk. One is right credit risk as usual. Second one is a market risk. Third one is the operational or systemic risk. Right. So we introduced a three risk model, and in order to address the risk, in order to minimize the risk, the Basel 2 set of guidelines recommended we should follow three pillar approach. In order to minimize the risk, in order to address the issues of the risk, the Basel 2 said we should follow three pillar model. That is three measures. First one is have capital adequacy ratio. That should be very clear to you. Have capital adequacy ratio. Meaning what? Because there is a risk, you might incur losses. To absorb the losses, have certain minimum capital. That is capital adequacy ratio. Second pillar, supervisory review. Third one is market discipline. Let's go point by point. What is supervisory review? Supervisory review simply means you as a bank, you know, you will face market risk, you will face operational risk, you will face credit risk. So you should implement certain measures, you should implement certain reforms in order to reduce all the three types of risk. Any problem with the second one? I'll repeat it again. I'll repeat it. As a bank, you will face a credit, market, and operational risk. You know that you're going to face all the three types of risk. So what you need to do is implement certain measures, implement certain reforms in order to ensure that the impact of all the risk will be reduced. Banks need to develop better risk management techniques to monitor and manage all the three types of risk. And the third one is market discipline. What is this market discipline? Market discipline ensures that whatever banks are doing, for example, right, imagine bank 1 is issuing additional tier 1 bond. They will have to inform this to RBI. They will have to notify RBI regarding what they are doing. Imagine one more bank is there, its capital adequacy ratio has fallen. So they will have to submit the data to Reserve Bank of India, right? Because many of you will have this kind of a doubt. Although nobody has asked so far, many of you will have this kind of a doubt. Sir, how does RBI know what the bank is doing? How will RBI know how much capital the bank has? How will RBI come to know, right, how much, right, is risk-weighted assets of this bank, etc.? My dear, under market discipline, under Basel 2 market discipline, Every bank that is regulated by RBI will have to keep on submitting data to RBI on periodical basis. There is no option available to you. On periodical basis, you will have to keep on submitting the data to RBI. So RBI will come to know how much is your capital adequacy ratio. RBI will come to know, right, how much is your risk weighted assets. RBI will come to know what kind of measures you are taking in order to reduce the risk, etc., etc. That is called as a market discipline. Requires disclosures from the banks to RBI. Right? That is called as a market discipline. So this is called as a three-pillar approach. And the last pillar, which is under the implementation now, right? Which is under the implementation right now, it is a Basel 3. This was announced after global financial crisis. That is, it was announced in 2010. What has been provided under Basel 3? It is an extension of Basel 2. Right? That is, do you remember the three-pillar approach under Basel 2? Let me know. Hardly a minute ago. Three-pillar approach under Basel 2 that has been continued under Basel 3 as well. Right? It is there under Basel 3 as well. But what are the changes? What has been newly introduced, etc.? Point number one. Right? Point number one, capital adequacy ratio now must be at least 9%. It should be at least 9%. Okay, that is point number one. Point number two, please tell me between tier 1 capital to tier 2 capital, can I say, we have discussed all of this. Can I say tier 1 capital, it is better to have more tier 1 capital compared to tier 2 capital? I'll repeat the statement. Two capital is there, right? That is tier 1 and tier 2. Both can absorb losses. Tier 1 can absorb losses much sooner compared to tier 2. That's the reason I said earlier we had discussed and concluded tier 1 is better compared to tier 2 in terms of absorption of losses. What Basel now says is because tier 1 is better, have your capital adequacy ratio 9%, but your tier 1 capital must be at least 7%. Right? It should be at least 7%. At least 7%. It should be at least 7%. Which means again logic remains the same. You should be more reliant. You should be more reliant on tier 1 compared to tier 2. Have more and more tier 1 capital. Okay. Third, capital conservation buffer. Slightly tricky. Please listen carefully. Now, right, I'll start with an example, then we'll come back to this just to lighten the intensity of the class. All of you have a wallet, correct? All of you have wallet. If you open the wallet, in one of the pockets, one of the place in the wallet, I'm pretty sure most of you would have taken a 500 rupee note or a 100 rupee note, folded it much compactly, and you would be hiding it in one of the part of the wallet. All of you will agree with me? Otherwise, I'll give you one more example. Very, very common example. Right? You cannot deny the second example. That is, in your money, cash will be there. Right? Whoever is earning, either father, mother, or both, doesn't matter. Cash will be there. But this will be done definitely by your mother, just like my mother. Some of the cash that she has, she will fold it very compactly, put a rubber band around it, and hide it in a sugar box or hide it right amongst the saris, etc. Correct? One of the boxes or amongst the saris. Right? Now, why? Why do you think you do that way? Why do you think, right, my mother, or your spouse, my spouse, why do they do that? Why do you think they do that? Don't you think they will simply give only one answer? Emergency. Correct? Emergency. They'll simply say, you don't know what is going to happen in the future. Suddenly you might require 500 rupee. So it will be useful during emergency. Apply the same logic to a bank. Apply same logic to the bank. Under Basel, right, the banks are supposed to maintain 9% capital. Correct? Under Basel, they're supposed to maintain 9% capital. But what if there is an emergency, the losses incurred are higher, and this 9% capital is not sufficient to absorb losses. Does it make sense to you? Right? Please participate. Let me know. Let's say there is an emergency, there is certain crisis, the bank's losses are higher. This 9% is not sufficient for you to absorb losses. So that is the precise reason. What Basel 3 says is they have used the term buffer. Buffer simply means extra. Remember this. Buffer simply means extra. Extra. Right? Apart from the capital that you have maintained under capital adequacy ratio. I repeat, under capital adequacy ratio, you are maintaining certain capital to absorb losses. Correct. Apart from that, or in addition to that, maintain certain extra capital. How much? 2.5% of risk weighted asset. And what is the use of this additional or extra capital that you are maintaining? In case of emergencies or unforeseen circumstances where the losses are higher, you cannot just absorb using 9%, then start using this buffer. Right? These reserves are built during normal times when the banks are doing well. Build them, keep additional money aside, and when the bad times will arrive, when there is an emergency, there is a stress in the banking sector, start using this buffer to absorb the losses. Any problem here? This is called as a capital conservation buffer, CCB, capital conservation buffer. Now that is the reason some of the books or some of the magazines or newspapers, etc., they will generally say the capital requirements under Basel 3 are capital adequacy ratio of 9% and buffer of 2.5%. Right? Can I say capital requirements under Basel 3 is 11.5%? Yes or no? Capital requirements under Basel 3 will be 11.5%. Don't get confused. Please do not get confused. This is how they will write 11.5%. Most of you will think, Are Baba, that fellow said 9%, but this book says 8% because internationally is 8%. Right? In case of another magazine, it is saying 11.5%, etc. This is how they are looking at the numbers in a different way. Okay. And finally, liquidity coverage ratio, LCR. Liquidity coverage ratio, LCR. What is this liquidity coverage ratio? Point number one, all of you will agree with me when I say cash that is there with the bank, G securities that are there with the bank are highly liquid assets of the bank. Think of it. I'll start with the statement again. Just think. Right? Just think of it. Cash that is there with the bank, G securities that is there with the bank, etc. These are highly liquid assets. Highly liquid means cash you don't have to convert, it is already in the form of money. G securities also, you can sell it easily. That also has very high liquidity. Now, what is this liquidity coverage ratio, LCR? Let me start. Under the LCR, liquidity coverage ratio, the bank is supposed to estimate that in the next 30 days, how much money will be flowing out of the bank. I'll repeat it, listen to me carefully. The bank is supposed to estimate in the next 30 days how much money will flow out of the bank, and whatever is the estimate, 100% of that they will have to maintain in the form of high quality liquid asset. I'll repeat it. Any problem, please do let me know. I'll repeat it again. Third time. The bank should estimate in the next 30 days how much money will flow from the bank. Whatever is the estimate, 100% of that they will have to maintain in the form of high quality liquid asset, HQLA, high quality liquid asset. Right? What is the use of it? But before that, let's say next 30 days the bank estimates 500 crore rupee will flow out of the bank. Out of the bank, 500 crore rupee will go, which means equivalent to this 100% of it is nothing but 500 crore. The bank has to maintain 500 crore rupee in the form of a cash, in the form of a G securities, which are basically high quality liquid asset. Why, sir? What is the use of it? Why should we maintain it? Reason is that if there is a sudden outflow, right, you don't know how much money they're going to withdraw, and if there is a sudden outflow, what if you don't have sufficient amount of cash? You have not estimated, you have not calculated anything. Sudden outflow of cash will happen from the bank, right? Don't you think bank will fall under the pressure because of that? Yes or no? But if you have estimated 500 crore, you have 500 crore worth of, let's say, at least G securities. If you do not have cash, you will sell the G securities in the market, collect the money, and allow for withdrawal of the funds. There is a situation called as a bank run situation. Understand this. There is something called as a bank run situation. What do you mean by a bank run situation? Whenever the bank will run out of its cash, remember this, bank run is not loss for the bank. It's not meaning loss for the bank. Whenever the bank will run out of cash, and even after that the customers are withdrawing cash from the bank, that is called as a bank run. All of you okay with this? I'll repeat it again. If you have a doubt, let me know. Right, when the bank is running out of its cash, no cash is there, but customers are continuously withdrawing money from the bank, this situation is called as a bank run situation. Right, so don't you think, if you do not estimates, if you do not have any kind of estimate, no idea whatsoever how much money is going to be withdrawn in the next 30 days, next 40 days, etc., you might end up experiencing a situation where customers are coming, you don't have money to provide to their withdrawal. That is the reason, in order to address all of it, not to address all of this, right, there is a concept called as a liquidity coverage ratio. 100% of next 30 days outflow, the bank has to maintain in the form of high quality liquid asset, such as cash, such as G securities. Now, one more point here. Whatever G securities you are holding under SLR, do you remember SLR? Statutory liquidity ratio. Whatever securities you are holding under SLR, right, automatically it will be counted as a part of liquidity coverage ratio. Please remember this. Right, RBI says whatever you're holding under SLR, because you're holding G securities, it will be counted as a part of liquidity coverage ratio. Done? All of you okay with this? These are certain, right, provisions regarding Basel 1, Basel 2, and Basel 3. To understand all of this, that's the reason we have discussed the basics of Basel. Those are also important. Do not try to read everything in detail. UPSC is not going to ask you such in detail. Basic concepts are sufficient. A last concept, very, very small concept. Tomorrow we'll pick it up from there. Last concept for the day. That is introduction to NPA. Right? What is this NPA? What is the meaning of NPA? Non-performing asset. Long form, non-performing asset. Right? What is this non-performing asset? Point number one, all of you will agree with me when I say assets are nothing but loans or advances given by the bank. Point number one, assets are nothing but loans or advances given by the bank. And whenever the bank will provide either a loan or advance, what they expect is they'll be earning interest on it, which will generate lot of profits for the bank, revenue for the bank. But what if the loan is given by the bank, the borrower doesn't repay it? So asset is not generating any income, not generating any revenue for the bank. These are called as non-performing assets. All of you can understand why these are called as non-performing assets now. Assets are nothing but loans or advances. The bank is expecting returns on these assets. But what if the borrower doesn't repay? Then in such a case, the assets are not performing, hence called as non-performing asset. Okay, that is point number one. Point number two. Point number two, sir, I will take a loan. I'm supposed to make a payment today. I will not repay it. Will it become NPA immediately? No. Please understand this. Last point for the day. If you take a loan, and let's say hypothetically, you are supposed to make a repayment On the 1st of January, I'm just taking a hypothetical number here. You're supposed to make a payment on the 1st of January 2023. That was the last day for payment. You do not make a payment. Now the bank will wait for 90 days. The bank will simply wait for 90 days. After 90 days is over, now they will classify this as a non-performing asset. Any problem in the definition? Any problem? Let me know. I'll repeat it again. Whatever was the due date, from the due date, the bank will wait for 90 days for the payment. If the payment is not done even after 90 days, then the bank will classify this asset as a non-performing asset. Right? Done? So we'll stop the discussion here. Tomorrow we'll start from the same slide. We'll understand what is this SMA 0, SMA 1, SMA 2, what is a doubtful, what is a substandard, what is loss making, etc. etc. We'll start with this slide tomorrow. Now, before that, if there are any questions from your side, please do let me know. Does this repo rate impact or external benchmarking thing applicable to every loan? I mean, education, vehicle, or home loan? Generally, the home loans, right, our personal loans, MSME loans, etc., they have been brought under external benchmarking now. Okay. Sir, I'm from a different background and economics feels difficult, my dear. I hope you understand. It's like learning cycling, right? Do you remember? Right? Childhood, right? Do you remember this? Learning cycling. Did you learn cycling on the first day? The very moment you kept your legs on both the pedals, did you learn cycling? No, of course no. Right? I also fell down. I'm pretty sure most of you also would also have fallen down. Just apply the same logic. Initially, because it's a new subject. I do understand. Right? I do understand. It's a new subject. Initially, you will feel this is very difficult. But trust me, once you start revising correctly, read current affairs, keep on updating your knowledge, trust me, economics is one of the very, very interesting subject for you. It's a very interesting subject. Okay, but again, I do understand some of you, or let's say many of you, are from a different background. Don't panic. Don't panic. Right? So tomorrow you don't have exam. You have exams next year. So you have sufficient time. Start reading, start revising. If you feel terms are difficult, you will get economics dictionary. Again, not mandatory because you have Google now, right? Because you have Google, right? Economics dictionary is not a must for you, right? Whatever term you are feeling difficult, you can definitely go to Google, get the answer from the Google, and start reading. So what I would recommend is, right, relax, don't panic, don't panic. Read, revise, update current affairs, right? Revise it twice, then automatically you will start understanding the concepts much more clearly. Don't worry. Okay. So can the banks decide the interest rates on the loans themselves? No, my dear. If the bank has given a loan to you on external benchmarking, then the bank cannot decide because the rate of interest is connected to an external benchmark. And as the external benchmark will keep on changing, automatically the lending rate will also keep on changing. Okay. Sir, how banks sell unsecured bonds to the consumer? Do they provide higher interest for this risk? Of course, yes. Of course, yes. It makes perfect sense also. They will provide higher rate of interest. They'll provide higher rate of interest for such type of instruments. In expansionary monetary policy, will there be increased cost of credit or decreased cost of credit? My dear, I believe you're talking when the bank will give a loan. Cost of credit, which is nothing but cost of funds. Cost of funds, a bank will pay, bank will also earn. I believe you're asking what will happen to rate of interest charged by the bank, right? Which is collected by the bank. In case of expansionary policy, expansionary means money supply will increase. And when money supply will increase, automatically interest rates should go down. Right? So in that case, rate of interest will go down. Okay, by the way, I don't know how many of you have read it. The list of the articles that I gave last week, Friday, around 14 articles. Were the articles relevant for UPSC? Question number one. Second, right, how many of you seen those articles coming in Hindu newspaper? Let me know. How many of you seen those articles coming in Hindu newspapers? If those were there in Hindu newspaper, let me know. Okay. CAR refers to fixed assets of the bank? No, my dear. No. CAR refers to how much minimum capital should be held by the bank in order to absorb losses. And the minimum capital that RBI has mandated for commercial banks in India is 9%, which means, just to give you a basic idea, what if your risk weighted assets are 200 rupees? If your risk weighted assets are worth 200, then the 9% means capital adequacy ratio, capital that you're holding, total capital should be minimum 18, right? So that is a basic idea. As the risk weighted assets will keep on changing, it means the bank is facing a higher risk, they should have more capital. That's a meaning. Okay. Sir, what is the operational risk? Operational risk basically means the bank will face a certain risk because of systems, because of people. For example, I said earlier, right, there was a machine that was installed to basically give change to the people. That is, people would deposit currency note, get coins in return. That was basically the idea. But because that machine was installed, RBI said at many points of time, people deposited fake currency note to the bank. Right? That is an operational risk because of the systems, because of the processes, because of the people. That is an operational risk. Okay. Basel 1 basically capital adequacy ratio of 8% and credit risk. These are the two very important points. It was introduced in 1988. Now, many of you are saying, sir, but in that book, here is this book, here is this, my dear. Announcement would be done in 1 year, adoption would be done in another year. All of you will agree with me? I'll repeat my statement. Announcement will be done in 1 year, adoption would be done in another year. From one country to another country, adoption year will change. That's the reason. Don't panic. Okay. Okay. What is DICGC? Deposit Insurance Credit Guarantee Corporation. The DICGC will provide insurance coverage to the deposits collected by scheduled commercial banks in India. Okay, commercial banks, whatever deposits they are collecting up to 5 lakh rupees, the insurance is provided by DICGC. That is, the bank will the bank will basically, right, pay 12 paise for every 100 rupee in the form of an insurance premium, and 100 rupee, right, for every 12 paise 100 rupee worth of deposit will be insured by DSCGC. Okay, done. So let me stop the discussion today here. Okay, let me stop the discussion today here. Tomorrow we can continue with the discussion on non-performing asset. Okay, so let me stop. See you tomorrow. Please read current affairs, update current affairs, revise, use annotated PPTs, read the articles, etc. Okay, so take care. Have a great day. Good night. See you tomorrow, sharp at 5 p.m.